I look at 10-year yield. The market is trying to gauge where this is going to shake out.
For bonds, it's still very much an inflation story.
The level of yields in the US looks pretty attractive.
Given positioning on where we have been in yields, I think we can go higher.
Now that we've seen this back up higher in yields, we are having the conversations of let's get ready to buy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Your equity market right now on the S&P 500, negative 0.1%. Coming into today, two-day losing streak on the S&P 500. Biggest two-day loss going back to March of last year. That was a month full of banking stress. Right now, a month full of better than expected economic data, including US retail sales. That data coming in hot, and yields looking like this. Your 2-year, 10-year, at the moment, the numbers as follows. 495 on a 2-year. On a 10-year, 464.88. On the month so far, which bear in mind is a little more than 2 weeks, we're up by more than 30 basis points on a 2-year, up by more than 40 basis points on a 10-year. And the sell side all saying the same thing. Morgan Stanley, rates matter again for equities. Lisa, SocGen, expensive valuations sitting comfortably with higher bond yields.
Because it's coming for the wrong reason. Part of it is the right reason and part of it is the wrong reason. Yesterday we saw retail sales come in better than expected, which caused the likes of Citigroup to increase their GDP forecast for the year. Positive, possibly, for equities. But you look to the other side, it's also stemming from increasing inflation expectations over the long term, which creates some issues of how high these rates have to stay for how long.
And we've heard the same thing from Fed official after Fed official, which is the following. 1, patience. 2, no urgency. And monetary policy is tight. Let's throw in that. 3, John Williams, New York Fed president, sitting down with Bloomberg's Mike McKee. Monetary policy is in a good place. Monetary policy is tight, immediately after a hotter than expected retail sales print.
Which raises the question, can they get ahead of this? Are they actually going to have the freedom to cut rates? To me, it seems like the market has moved on from Fed speak. It seems like unless Jay Powell says something today at 1:15 p.m. that really reiterates a time frame for those rate cuts, the market is looking at the data and increasingly pushing out potential rate cuts. Now, fewer than 2 being priced into the market at a time where you've got hot inflation, but you also have this sense you're having commodity pressures that are going to make life really difficult for central bankers.
Tons of Fed speak again this week, including Chairman Powell. Later on this morning, earnings from Bank of America. In fact, they come this hour, 7:30 Eastern time. We're looking for numbers from Morgan Stanley. A lot to work through this morning. You've got to talk about the hot data, the Fed reaction, the Fed response to it. We've got to talk about China. Data in March, just a little softer than expected. And we need to talk about the response potentially coming from Israel. This, Anne-Marie, from the Israelis, there will be a response.
Yep. Now everyone is focused on what the timing of that response will be, Jonathan. Of course, what Israel potentially will hit. What I like to look at is actual tangible things that are happening in the region, not just what people are saying. And what we've heard from the IAEA is that their inspectors are no longer allowed to continue inspecting some nuclear facilities. Why? Because the Iranian authorities say they are keeping them shut because of security considerations. So potentially Tehran thinks this could be a target that Israel would want to hit.
And this from Axios just moments ago, Lisa. Treasury Secretary Janet Yellen preparing fresh sanctions for Iran, vowing the following. The United States will not hesitate to inflict economic punishment in response to the Islamic Republic's unprecedented attack on Israel.
Yeah, well, what's the willingness to actually absorb the consequences of that in terms of higher oil prices? And this has been the perennial challenge. How much do you want to enforce sanctions that are going to cause oil prices to spike right ahead of the election? And this is the toggle a lot of people are playing with.
Crude prices a little softer this morning. Let's go through the price action for you. Starting with WTI, we're down about 1/3 of 1% to $85.10. On Brent crude, we're down about 1/3 of 1% to $89.83. For the equity market, pulling back just a little bit on the S&P 500. Some negative follow-through from yesterday's session in the United States in the afternoon to the European session through this morning and into their midday. We're looking at equities down in Europe on the FTSE by 1.5%, on the Euro Stoxx 50 by more than 1%. Yields up again by 4 basis points, call it 5, 464.88 on the US 10-year. Coming up this hour, we'll catch up with Russ Kostrick of BlackRock on the global stock market sell-off. Jeanette Lowe of Strategas as Israel vows to respond to Iran. And Chris Marinac of Jenny Montgomery Scott with Bank of America and Morgan Stanley earnings on deck. We begin with our top story, equities selling off with bond yields near year-to-date highs. Russ Kostrick of BlackRock saying this: we remain overweight equities, though less so than a month ago. We still believe that a strong economy will drive double-digit earnings growth, which should allow for additional gains through year-end. Russ, I'm pleased to say, joined us now for more. So Russ, still overweight. So let's start there. You've got to explain to us why the bullish thesis is still intact.
Well, good morning, Jonathan. I think Lisa described it well a few moments ago, which is that you had this backup in rates, which has clearly dislocated the equity market, at least in the short term. But that backup contains both good and bad. The bad is obviously the sticky inflation. The good is an economy that is much, much stronger than anyone expected 3 or 6 months ago. And again, if you go back, let's say to last summer, and you look at the consensus of Bloomberg economic forecasts, economists were expecting maybe the U.S. economy would grow about 0.5% in 2024. And obviously that reflected a lot of economists that still expected some recession probability. You go today, you look at those same numbers, growth is expected to be 2 to 2.5%. You layer on, let's call it maybe 2.5% inflation on top of that, you get to an environment where nominal growth for 24 is probably going to be in the ballpark of 5%. If you get that, you're going to get decent earnings growth, probably even better than is discounted right now in S&P estimates. And that's something that's a very different dynamic than last year. Remember, last year was all about multiple expansion, people paying more for a dollar of earnings. This year, we do think the equity market can go higher, but it's not likely to go higher on higher valuations. It's likely to go higher on better earnings.
Which raises a question of what's going to lead it there, especially because the higher valuations has really benefited the big tech complex that took it on the chin yesterday and seemed to be struggling in this new multifaceted world. So what's the leadership?
Well, again, I think yesterday, at least you're totally right. Tech did struggle, but you've had other days where tech actually has held up remarkably well when you consider the backup in rates. Now, again, I think we have to be a little bit more specific here. Early growth tech companies have definitely struggled along with small caps. Why is that? They are sensitive to this backup in yields. But you think about many of those mega cap tech companies that are generating extraordinary amounts of cash flow, they're still actually doing very well. And we still would expect for this quarter in particular for many of those companies to lead on earnings growth.
One thing I'm thinking about a lot today is there are a lot of comparisons to March of last year, whether it's the biggest sell-off in the S&P, as John mentioned, whether it's the biggest spike in the VIX that we've seen over the past 2 days. How close are we to another moment like that with higher yields, based on the fact that small banks still haven't dealt with the problems? They still are much more vulnerable to higher rates for a longer period of time, especially without some of the deposit stability that a lot of people have been looking for.
Well, I definitely agree that the regional banks, some of the smaller banks are vulnerable. We've actually been underweight that sector for some time. And then the other part of that, which we haven't gotten to, is commercial real estate. So that's part of the economy that I'd be concerned about, not in the sense that we're looking at a systematic crisis, but just that these banks do have a lot of fundamental challenges. But again, you go back and you compare the economy today to a year ago. A year ago, the concern was after Silicon Valley Bank, after First Republic, after Credit Suisse, we were looking at another systemic banking crisis. I don't think that's the problem today. Today, if anything, we have the opposite problem that, aside from some issues in some of the smaller banks, the economy is very robust. We saw that again yesterday with retail sales. And if anything, rather than people adding Fed cuts, which was the case a year ago, now they're taking them back.
Russ, there's a reason, though, as you know, why some people are still calling this survive until 25 in certain parts of fixed income, because they want rates to come down by 2025, and they need to survive until then. It's very self-explanatory. So, Russ, I'm trying to work out whether credit is starting to confirm some of those concerns. Now, spreads have been very, very tight. They've just started to widen over the last week or so. How would you frame the moves developing in credit?
So credit has been interesting. As you say, spreads are tight, and what we've really been doing in the portfolio is maintaining the credit and the spread exposure we have. And that has been a very nice tailwind. It's allowed us to carry above the benchmark. But again, I think you have to go back to the strength in the economy. It's not that there will not be pockets of stress, particularly as rates rise. But if you have an economy where growth is solid, and let's remember, many of these companies, including those in high yield, refinance their term, how the distribution of when their maturities come due. They refinance that back in 21, 22. So you're actually looking at an environment where we think the default rate for most of those companies is going to stay low. It's actually today fairly well below the long-term average. And if you have that position in your portfolio, you can carry above benchmark. You don't necessarily have to be in a rush to sell it. Although I agree, at this point with spreads where they are, you may not be adding much either.
Russ, you've said it a few times in the last 5 minutes, the strength of the economy. I think we need to be more specific than that. The strength of the US economy. Can we talk about the rest of the world? Can you tell me how that factors into some of the things you're telling us this morning?
So I do think the US is leading. And this is one reason we remain overweight US stocks. We still have a little bit of an overweight of the dollar versus the euro. And this does respect this growth and this differential in growth that we see. Europe clearly struggling a bit more. Japan is actually doing okay. China, we had some positive news this morning. But I do agree that this is a global economy, as we've seen many times in the past 20 years, that is primarily being led by U.S. strength. And again, a lot of that strength is based in the U.S. consumer, where you've got a strong labor market, you've got decent household balance sheets, and you've got a consumer that clearly is still willing to spend.
Russ, let's fold that into the policy conversation. We've been discussing it over the last week, the limits of central bank divergence. Russ, what do you think they are?
In terms of the divergence between the U.S. and other central banks?
The ECB, the BOJ. Look at the euro this morning, 106. Dollar yen pushing through 154. Yeah. I think we're just trying to work out how much further the ECB could go without the Federal Reserve joining them in a rate-cutting cycle.
Well, I think the ECB is probably going to have more latitude to cut than the Fed. And the reason for that is obviously you've got a weaker economy in Europe. The U.S., we do have some persistence in inflation, particularly around services, which you're not seeing in every other part of the world. So one of the reasons the dollar's been so resilient is because you do have that policy divergence. And there's another aspect to that as well, which is interesting. You know, again, we've spoken about this in other broadcasts. Up until 2021, when you think about building a portfolio, what is your hedge against equity risks? For 2 decades, it was generally bonds. Clearly not the case in an environment where macro volatility has been higher, inflation volatility has been higher. What has worked very well on these days when equity markets have sold off is generally been having a long dollar, overweight dollar position. Because if you're worried about the Fed, when the market is selling off, generally you're seeing better dollar strength.
Just to put a bow on that, to me, it seemed like when I walked in, there are 2 haven trades now that work. Gold and the dollar. That's it. Bonds don't work that way. Is that kind of how you're playing it?
You know, I totally agree on the dollar. The gold has empirically worked that way. I have to be honest, I have a much harder time explaining the move in gold. Clearly, there's some central bank buying that's supporting that. But when you look at what's happened with the dollar, if you look at what's happened with real or inflation-adjusted interest rates, it's very hard to explain why gold's doing what it's doing. One explanation might be that obviously we're in an environment of heightened geopolitical risk, and many investors might be leaning on gold as they have in the past. Is that geopolitical safe haven?
Hey, Russ, great to catch up, buddy. As always, Russ Kostrick there of BlackRock. Still bullish, still overweight, this equity market. Speaking of gold, do you see the call from Citi?
3,000.
3K.
Crazy.
Bullish call from Goldman, too, in the last week as well.
Coming from the idea that people are going to pile in. They're going to ride that train that the central bank started. And honestly, this is what we've heard pretty much across the board. Raising this question, again, is this the new haven? You got gold in one pocket. You got the triple leverage gold fund, the triple leverage dollar fund. You know, kick bonds to the curve.
It's EK if you're watching.
That was for you.
Lisa trying to inspire maybe some new products for 2024. Gold just a little bit softer this morning. We're negative 0.4%. Let's get you an update on stories elsewhere. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Well, you stole my thunder. I was going to start with gold, but instead, let's get to the geopolitics. Axios is reporting that the U.S. Treasury is preparing fresh sanctions for Iran following its weekend attack on Israel. The Treasury vowing that the U.S., quote, will not hesitate to inflict economic punishment on Iran. The move comes as President Biden urges Israeli Prime Minister Benjamin Netanyahu to be strategic and show restraint when it comes to possible military action. Xi Jinping is pushing back against European and U.S. pressure to rein in China's powerhouse industries. The Chinese leader told German Chancellor Olaf Scholz that a surge in Chinese clean tech exports has helped the world tackle inflation. Xi's comments suggest China may not be swayed in any meaningful way by Western leaders who want the country to reduce its excess manufacturing capacity. Shares of Tesla falling in the pre-market. Two of the company's top executives have announced that they're leaving the company amid the car maker's largest ever round of job cuts. Tesla is cutting 10% of its workforce to slash costs as EV demand slows. Sources tell Bloomberg that the cuts could reach closer to 20% in some divisions. Already so far this year, Tesla shares are down more than 30%. That's your brief, John.
Hey, Danny, thank you. A difficult moment for that industry, that's for sure. Up next on the program, Israel vowing to respond.
Israel proved it has superior military capability, and just as critically, they don't stand alone, that the United States stands with them. There's no question that Iran recognizes the coalition that was put together to help Israel defend itself.
That conversation up next, live from New York City this morning. Good morning. Live from New York, welcome to the program. Equities a little bit softer this morning, down another 0.2%. The biggest two-day loss going back to March of last year on the S&P 500. Really weak session yesterday. Bond yields higher again by 4 basis points on a 10-year, 464.68. And crude behaving itself for now. WTI, $85 and about 10 cents. Under surveillance this morning, Israel vowing to respond.
Israel proved it has superior military capability, and just as critically, they don't stand alone, that the United States stands with them. There's no question that Iran recognizes the coalition that was put together to help Israel defend itself. Again, I can't speak for what either side will do going forward. Iran is increasingly isolated on the world stage. They are increasingly making it harder for anybody in the international community to be sympathetic to any of their inimical interests there.
Here's the latest. Israel's military chief saying Iran's unprecedented attack will be met with a response. He provided no further details. On Capitol Hill, House Speaker Mike Johnson planning to hold long-delayed votes on new aid to Israel, Ukraine and Taiwan. Jeanette Lowe of Strategas, a bed company, joins us now for more. Jeanette, let's get to the nature of the response we can expect, the options on the table. What do you think they are?
So I think Israel has a number of options. They're going to try to do something to somewhat, proportionate to say, Iran did a huge barrage of missiles and drone attack on Israelis' airspace. So they want to do something probably to counteract that. Now, they have a couple of options. Maybe they target, a drone facility in Iran to try to take out the actual munitions that were the culprit of this attack over the weekend. That way, they're not actually causing any casualties. They could do something more covert. They could do a cyber attack. They could wait to kind of bring down the temperature a little bit and then act again at some point in the future. So they do have several options. I think there's definitely pressure from the West to try to turn down any escalation in the region and try to say that they should not retaliate, but does seem like Israel's going to do something. It's just whether or not it is escalatory or not.
Jeanette, we learned yesterday that Iran is temporarily closing its nuclear facilities and they're citing security concerns. Is nuclear an option for Israel?
So they have done that in the past, right? They have targeted Iran's nuclear facilities, its nuclear capabilities, its development. So that is definitely probably something that they are concerned about and thinking about whether or not that could be an option, especially as you've had, increased uranium enrichment in Iran. I don't necessarily know if that might be on the table, but that is something that they have done in the past. It might have to be more of a cyber attack than actually doing a bomb, because that would be quite significant since most of these facilities are actually underground. But that is probably something that is still on the table.
Are we in the start then of a vicious cycle? Because once Israel responds, is it warranted then that Iran is going to respond? Is that what you would expect?
Right. So this is where this delicate balance has to come into play. So if you kind of look at what happened with the U.S. when we killed General Soleimani in Iran back during the Trump administration, Iran struck back, but it hit targeted U.S. bases, but there were no casualties, and that kind of allowed, de-escalation to then occur. What Israel's response here might be is going to be important. Again, if they try to target something like a missile depot or something like that, that's not a strong strike, maybe it's just a little bit more targeted, that allows things to calm down and not require Iran then to retaliate again. So I think there does have to be this balance to try to figure out how can they show some strength, but at the same time not escalate things further. I do think Iran does not want to actually have a major conflict. They do not want to get the U.S. involved. And so there is also that piece of it, which is also why the U.S. and other Western allies are trying to get Israel to lower the temperature and to maybe not retaliate.
Jeanette, on the domestic front, this raises a question of whether it's more likely that there is some aid passed in the near term. We know that the House is interested in taking up a bill, but possibly two separate bills for Israel and Ukraine financing. What do you think the probability is that we're going to get something or see some action on this front in the next couple of weeks?
So we actually are quite optimistic that we are going to get something done. I think Speaker Johnson has been much more supportive of getting aid to Ukraine since he's moved into the leadership position. And this has been something that he's been talking about getting done once they came back from the March recess. He's now putting something on the table. This does have the opportunity. It's a tricky package that he's trying to put together because he's trying to create separate packages for Ukraine aid, for Israel aid for Taiwan, but then also putting some other pieces into this as well, kind of things like the repo acts where they could seize Russian assets and use that to pay for Ukraine reconstruction. They're thinking about re-putting the TikTok bill back into this package, so that way the Senate would be forced to vote on whether that the app should be divested from ByteDance. So they're going to then package it and send it over to the Senate to try to force the Senate's hand a little bit on this and pushing it towards the end of the week. But we are optimistic that they can get it done. It just might be a very messy process, and there might just be some, changes to what the legislation was that came out of the Senate.
In the meantime, the administration is looking to act unilaterally in the ways that they can. Axios reporting this morning that Treasury Secretary Janet Yellen is saying that she will not hesitate on new Iran sanctions actions. This raises a question: how willing is the United States to enact some sort of policy that would cause oil prices to significantly increase ahead of the election?
Right. So that's definitely a risk for the president as he goes into this reelection. We go into summer driving season. We're already seeing gas prices go higher. They're expected to obviously go higher during the summertime. So they're not looking to have an increase in gas prices over the next couple of months, as that's going to hit American pocketbooks. And that's never a good thing for the president's approval rating and then leading into the ultimate election. So I think they do need to be careful here. Obviously, sanctions have had a modest impact. And so you still have China buying Iranian oil, which is not helping to actually make them enforced. But the president does have other tools as well. He may let oil out of the SPR again this year to try to help with oil prices. But I think they're going to be targeting Iran sanctions. There's going to be bills in the House. There's going to be bills in the Senate. They're going to try to get that enacted. But I think right now the bigger pressure is probably to put more pressure on Iran, either through China or just to get them to maybe stop with the Houthis. These are the kinds of things that they're actually going to probably be more focused on rather than actually trying to stop oil from Iran.
Jeanette, you touched on it. Do we need new sanctions, or do we need to enforce existing ones?
Yeah, I mean, this is the big question. We have been putting in numbers of sanctions on Iran for quite some time. And the problem is that what you're starting to see is that there are these countries who have been sanctioned by the United States, countries like Russia, Iran, North Korea, that are now trying to create these ways to skirt these sanctions. We had some talk out last week about China and the way that they might be helping Russia in its war with Ukraine by providing some dual use pieces that go into military equipment to help them with their offensive against Ukraine. And that's kind of doing it sanctions evasion in some form. So this is kind of the problem. We're having these other countries who are now trying to challenge the United States, challenge the United States' sanctions regime. And this is kind of the problem that we're moving into this new era. It's much more multipolar world where you have countries like China and Russia and Iran trying to challenge the United States, trying to actually distract the United States, which a lot of different skirmishes. You've got Ukraine, you've got what's going on in Israel, what's going on with the Red Sea. And all of that is designed to start to try to divert U.S. attention, use up resources, use up the federal budget, use up munitions, and kind of create this opportunity for the U.S. to have less power and other countries to have more.
It's a massive issue. Jeanette, thank you. Jeanette Lowe there, a strategist. Let's go to the words of Admiral Kirby yesterday with us. Iran is increasingly isolated on the world stage. They are increasingly making it harder for anybody in the international community to be sympathetic. Memo, Russia, memo, China, did they get it?
It's very challenging because I would love to know what the administration defines as isolated. You have Iran exporting more than, or producing at least more than 3 million barrels a day, all that going to China, as well as sending weapons to Russia, and at the same time, fresh new diplomacy with some Arab leaders.
On sanctions, expect to hear from Secretary Yellen a little bit later on today. Coming up, Constant Hunter of Macro Policy Perspectives, looking ahead to Fed Chair Jay Powell's comments a little bit later this afternoon. From New York City, this is Bloomberg. Shaky start to the week in global markets. Yields up, stocks down. Let's check it out right now. Stocks down, yields up. Kind of a repeat of Monday. just less aggressive. Equity futures down 0.25% on the S&P 500. On the Nasdaq, we're down about 0.4. Small caps pulling back again, down by 0.9. Tech was outperforming, then it got hammered. I can't keep up. Every single industry group was in negative territory at the close yesterday. Let's turn to the bond market. 2-year, 10-year, 30-year. The 2-year at the moment about 4.95. Up another 4 or 5 basis points on a 10-year to 4.6447. Lisa, at the front end of the curve so far this month, up more than 30 basis points. On a 10-year so far this month, up more than 40 basis points. It's been quite a repricing in fixed income.
And it strikes me that the reason why people said that rates and the increase in yields hadn't affected stocks more was because the pace was sort of the slow grind. Well, in the past couple of weeks, this has been something other than a slow grind. This has been a shift dramatically higher in light of the hotter than expected CPI and then all the follow-on reads that have all been hotter than expected. It's the pace, it's the increase in inflation expectations, it's the overlay of geopolitical concerns, it's the overlay of valuations that people want to sell. And this raises the question, is it actually going to be a dip, or is everyone going to buy it before we get there?
The dip so far is about 3 to 4% on the equity market off all-time highs. The data so far this month, we'll talk about it more in just a moment. I think it started with the ISM manufacturing, prices paid, really punchy. And that was it. Yields up and away, and that's where we stayed. Let's turn to foreign exchange. Push the bond market moves through FX, and these are the numbers you get. I remember, Lisa remembers, everyone around this table remembers when 152 was a problem for the BOJ. Then 153 happened. Then 154 happened. And Lisa, now we're having a conversation about not just 155, but some people talking about 160 on dollar yen. This morning, 154.54.
Those some people, JP Morgan and Bank of America, talking about 160 on the Japanese yen, because at this point, it's a policy response to something that is fundamental. Can they fight against this freight train? Ultimately, this raises a question of how far the globe can diverge from the U.S. And you were asking this earlier. And honestly, it's compelling to me because it's such a difficult nut to crack. It's not just the dollar. It's not just their currencies. It's also oil prices. And we heard that today from the ECB, or from one of the members who said, we can cut rates, but our hand might be called by geopolitics.
And the price of crude. Mohammed Al-Erin's is going to join us in about 30 minutes' time, so don't miss that conversation on U.S. exceptionalism. Under surveillance this morning, your top stories. China reporting faster than expected economic growth. The country's GDP growing 5.3% in the first quarter of the year. However, the data coming with a reported slump in retail sales and industrial output for the month of March. So, Bramo, decent quarter, weaker end to it. Is that the way you frame things?
People are worried that maybe it's losing steam. There's a sense that maybe it's not going to fuel the same kind of growth. If you dig within the numbers, there's also another takeaway, and this goes to a policy question that we've been talking about, which is that the gains came from factory output. It is the exporting of cheap goods that they want to support their economy. And it's working on the margins, to the big chagrin of policymakers around the world that don't want cheap Chinese goods flooding the rest of the world. And that, to me, sets up this sort of shift of domestic property investment to factory output, which is exactly what a lot of people don't want to see.
Absolutely. When you look at the domestic demand, it's not even flat. It's really underperforming when it comes to China. And this is the problem that's holding the country back economically. You look at what Bloomberg economists say. They say the pickup was almost entirely driven by public investment and that the private demand suggests the recovery is on thin ice. So there's this standout potential closer to getting that 5% target. But under the hood, it's looking really shaky.
This has got to be a big feature of the IMF World Bank spring meetings later on this week, hasn't it? Hasn't that got to be top of the pile?
On one hand, you have to think if you're worried about inflation, the disinflationary impulse from China has to be somewhat welcome. How can you say we want more expensive goods? On the flip side, how do you talk about unfair competition and how you understand what the new global level playing field is when it is highly confusing? This is a fraught moment. It's a great moment for us to be going to Washington, D.C.
It's a lose-lose situation, I think, for politicians, and I think it's a good excuse to go. I agree with you.
Thank you.
We'll be in the nation's capital later on this week. Special coverage for Bloomberg Surveillance Thursday and on Friday. Let's turn to this story. Top military officials in Israel saying the country will respond to Iran's first ever direct attack on the country. Allies warning a tit-for-tat response could lead to a wider war. An Israeli military spokesman telling Bloomberg the government has been presented a range of possible options. So, AMH, let's talk about the potential options. What are they?
Well, we heard from Jeanette Lowe, and she's talking about something like potentially cyber. There's potentially, she's talking about this diplomatic dance Israel needs to do to show force and strength, but also not create a retaliatory cycle. One thing that Iran is doing, we know from the IAEA as of yesterday, is they said they're not reopening nuclear facilities because of security concerns. So that says to me that Tehran is incredibly worried that that could potentially be a strike target from the Israelis.
The word we used a lot on yesterday's programme was contained. And I remember Lisa responded by saying, yes, sure, contained, but not calm. And I think that's where we still are, contained, but not calm.
We don't understand what the response is. I don't even understand who exactly is leading the charge in Israel, because there are 3 members of the war committee and they're at war with one another and they're longtime rivals. So you take this out. How does the U.S. influence 3 warring rivals to not necessarily escalate this? It's a really fraught moment, which is the reason why you see that nervousness under the hood.
If you are just waking up and tuning in, you probably want to know what the price of crude is this morning. Brent crude is just a little softer. We're negative by 0.25%, just a break of 90. Again, 89.88 on Brent. WTI 85.16. Let's turn to the Fed speak. President Mary Daly saying there's no urgency to cut interest rates. The comments coming after Williams said he still expects cuts to begin this year. Got a host of Fed speak on deck today with Jefferson, Williams, Barkin, Collins and Powell all speaking. Constance Hunter, a macro policy perspectives, joins us in New York around the table. Constance, good morning to you.
Good morning. How are you?
I'm really good. And I think we're all trying to work out where the Fed is right now, given the recent economic data. Michael McKee sat down with the Fed president of New York, John Williams, and he said monetary policy was in a good place. Monetary policy is tight. Is that how you would describe monetary policy right now, relative to the information, the data we're getting?
Yeah, I mean, they're in a good place because they have room to move. So if we see a deterioration in economic conditions, they have room to move down meaningfully. They're in a good place because the economy does appear to be chugging along. We got the retail sales yesterday. We can debate how strong they really were under the hood or not under the hood. On a real basis, year over year, they're up 0.5%, and they were negative for the first 2 months of the year. So retail sales for the quarter on a real basis are negative, yet trending slightly higher, right? So that, you could say, consumers chugging along. You know, there's cracks in the financial system here in the U.S. in the sense that we have commercial real estate as this slow burning thing. There's certainly some cracks under the hood. We're concerned in some regard with how strong the labor market is, and of course, inflation is giving us a lot of mixed signals right now. So. If you dig under and you look at what percent of goods are changing price, that's a really good indicator with regard to is all of the price movement one way. So we're seeing that it's actually two-way on a month-to-month basis under the hood. That's a good sign that it'll continue to trend down, but it's being much stickier than the Fed wants. So they are in a good place. They can hold rates. But if things deteriorate, they can also cut rates and have a substantial impact.
Can they hike rates?
They could hike rates. That is not my base case. I know a lot of people have been floating that. I see you're going to have Torsten on later. He's going to be talking about that.
He's going to be talking about no cuts.
No cuts, I guess. But, you know, people are floating this possibly they hike. And certainly, look, we have the risks that we have geopolitically. And as you were talking about, at the bottom of the hour, right, there's these cross currents. You have the deflation coming out of China, but you have the possible inflationary impact of higher oil prices. So, we just have to wait and see.
When we talk about central banking response to some of the geopolitics, Olli Rehn, over on the Governing Council of the European Central Bank, came out overnight and talked about how geopolitics pose the biggest risk to rate cuts for the ECB. This is fascinating and speaks to the whole idea of the divergence of the euro and what that does if oil prices are also spiking. How much do policymakers have to respond and have to consider a tighter monetary policy in response to higher commodity prices on the heels of geopolitics?
I mean, geopolitics is why Europe is in the position it's in right now, right? It was the Ukraine war that caused so many price increases in Europe, that caused supply constraints. So if you look at the underlying strength of the individual European economies, they're much, much weaker than the U.S. They don't really warrant this level of interest rates, except that the ECB had to respond to the price movements that were brought about by geopolitics.
In the UK, there's a really interesting conversation developing, and I actually think it started with Governor Carney a number of years ago. He talked about how the speed limit of the British economy had changed. And an old friend of this programme, Megan Green, I think, wrote about that in the Financial Times recently. Yeah. The UK is not the United States, that they can't run a high-growth economy because it will mean much higher inflation. What does that look like in the United States? What is the speed limit of the US economy?
Well, and John Williams talked about that a little bit yesterday, right? So if we have higher productivity, we have for a period of time, higher immigration, and that raises potential GDP. And you're talking about it being raised from 1.5 or 1.8 to 2 to 2.2. That's meaningful. Like, you're compounding 40 basis points over several years. That is a significant change. And so, we're definitely of the view that many of these productivity gains are just getting started, that there are a lot of positive virtuous circles happening within the economy to fuel that. And if that is the case, if we end up being correct and we can have productivity gains of 2.2% reliably for the next several years, plus slightly higher population growth due to immigration, we're looking at a potential GDP that sets us up really well to have a nice late 1990s period of growth.
I know you've been focused on that a lot. Can we just sit on productivity a while longer? What are the tailwinds for durable productivity gains in this economy?
Yeah, so there's several. One is that we're having this high level of business formation, and we thought that was a sort of COVID thing, that it would fade. It's maintained this very high level that we hadn't seen, actually the highest ever. So when the data first started being collected in 2005, we're way above those levels, right? And newer firms tend to be more productive. They adopt new technologies, and that's a really good thing within the economy. Then, of course, AI, and I mean not just ChatGPT, but all the forms of AI that are still diffusing throughout the economy. That is so significant for productivity gains, and that is really just starting to be deployed widely, right? There was just a paper out from NBER, a number of really well-known authors talking about the use and diffusion of this technology, and it's growing, and it's expected to continue to grow. And then, of course, you have tech workers being laid off, and they're diffusing now out into the economy. That diffusion brings technology know-how into other companies, which is a good thing. When I was at AIG and we were trying to hire programmers, we were trying to hire tech workers, and so 2022, you couldn't buy them at any price, right? And we're not stupid. We're like, okay, well, this is going to come back eventually. We're going to have to scale back our hiring plans. And now all these firms are able to hire these workers, and that diffuses the technology throughout the economy.
You also look a lot at capacity utilization. What are you seeing in terms of the different industries? Who's ranking the highest?
Yeah, so manufacturing is very high right now, and that makes sense, right? You've had this huge build out in manufacturing capacity in the U.S. That's where a lot of the structures CapEx is going. That's really the CHIPS Act, right? And so again, you're seeing those new factories are also more productive, right? Because if you're building a new factory, you're going to make every aspect of it the latest technology.
Constructive on the American economy. Constant Hunter there of macro policy perspectives. Want to get you an update on stories elsewhere just briefly. Before we get to our brief, we're looking for Bank of America results. Those earnings are going to drop any moment. Before we get them, let's get you up to speed on the news elsewhere. Here is Danny Berger. Hey, Danny.
Hey, John. Another bank, another upgrade to gold. Citi's new target is $3,000 over the next 6 to 18 months, juiced this time by money managers as they play catch up from demand we've already seen from consumers in China and central banks. The latest leg of this rally, which hit an all-time high yesterday, has been driven by haven buying. President Biden is hitting the campaign trail in his home state of Pennsylvania. Biden's campaign says that they're going to be highlighting the differences between the president's tax and economic agenda versus that of Donald Trump, who oversaw tax cuts for the wealthy and corporations. Biden's trip will include Pittsburgh area events, where Nippon Steel's takeover deal for U.S. Steel has irritated his union allies. And the best thing to happen to basketball in a long time, Caitlin Clark has gone first overall to the Indiana Fever in the WNBA draft, surprising no one. The former Iowa star became a household name during her record-breaking college career, playing a key role in driving TV ratings for the women's March Madness tournament. Can she do the same for the WNBA? She'll be faced with turning around the Indiana franchise that hasn't made the playoffs since 2016. That's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, wrapping up earnings on Wall Street.
There are still big macro risks in the marketplace. I think strength and stability seems to be a bigger presence in the strategic boardroom of these banks.
Numbers from B of A just drop in that conversation. Up next. Equities right now on the S&P 500, just negative, just about negative 0.04%, recovering just a touch in the last 10 minutes. Under surveillance, wrapping up earnings on Wall Street.
There are still big macro risks in the marketplace. And I'll tell you, when I talk to bank management teams, it's almost like I feel like I'm having a credit analyst discussion more than an equity analyst discussion. They're very focused on their own balance sheet. I think strength and stability seems to be a bigger presence in the strategic boardroom of these banks.
Here's the latest. Bank of America and Morgan Stanley reporting as Wall Street's biggest banks wrap up earnings. Goldman raising the bar in the last 24 hours, posting a surprise 28% jump in profits. Bank of America dropping right now. Bloomberg's Sonali Basak joins us around a table. Sonali, Brian Moynihan saying it was a strong quarter. How strong?
Strong enough. You had them beat on net interest income. Remember, this is very good news after we did not see the same over at JP Morgan and at Citigroup. Of course, Bank of America, with its big lending presence relative to trading investment banking, exactly what you'd want to see. They actually came in above where they were last quarter. Remember, there was a worry they would be trending lower. Also, when it comes to trading revenue, they were in line to missing a little bit on fixed income, but equities beat expectations. So all in all, it's really the net interest income here that has the first look over at Wall Street.
I want to get to this headline as well, the $700 million FDIC special assessment expense. Not the first time we've seen this in bank earnings over the last couple of quarters. Can you frame whether this is complete, whether this is done? How far along are we in this process?
It's still coming. And remember, you look at the efficiency ratio. That's another place that they missed analyst estimates here. They came in above where Wall Street was guiding for. It's now at 67%. And listen, with an era where they're already trying to keep a handle on costs all over the board, all of these banks have really suffered from the weight of that FDIC assessment. Even JP Morgan had guided their expenses higher in part because of that assessment. So the story's not over. Regulatory costs may remain somewhat high, but we are getting past at least that first year now since the bank failures that began last year.
I'm old enough to remember when it was sort of cost cutting and that was trying to reduce the expenses was the focus of so many of these banks. We saw JP Morgan costs coming in above expectations. Bank of America, first quarter compensation expenses, $10.2 billion versus the expectation of $9.99 billion. What do you make of that?
Direction of travel is higher. Listen, we've been talking about it with Goldman, where if you're making more money, you also have to pay people more. That's the problem behind it, isn't it? And so, you know, on balance, again, that efficiency ratio being higher, it's that flurry of ideas here, the compensation being higher, the regulatory charges being higher. So keeping a handle on costs. One good news is because that net interest income came in above expectations, interest expense, Lisa, you've been pointing at it all season, that has been a big weight on that net interest income. And for them to come in a little higher is good news, at least on that expense line.
Sonali, stay close. The stock is down by about 0.1% in the pre-market. An upside surprise on trading revenue. To weigh in, Chris Marinac of Jenny Montgomery Scott joins us now for more. Chris, you've had a few moments to go over this one. What's the signal you're taking away from earnings season so far?
Well, charge-offs, John, are rising, and I think the overall provision expense is mixed. We saw provision rise for B of A this morning, which is a good thing because they had a pretty healthy step up of their net charge-offs. I do think it's interesting that we're seeing deposits act very well. Deposits grew for the whole system in Q1, and they were higher for B of A this morning. You're particularly seeing that in the wealth management business for B of A. I also think that the balance sheet is seeing a little bit of expansion on the securities book, which is another way for the company to try to manage net interest margin, take advantage of higher interest rates.
Chris, this is something we've seen as a theme. We saw this with Goldman Sachs. We saw this with JP Morgan, the use of a balance sheet to really engage with fixed income currencies and commodities trading and others. How much is this a new tactic, in part, we were talking about this yesterday, to compete with the private asset managers?
Well, some of that is true, Lisa. I think the other thing that's happening is the banks simply want to try to grow net interest income this year, provide themselves latitude on PPNR, which gives them cash flow to earn through the cycle. As losses rise on whether it's commercial real estate, C&I loans, or consumer, you're going to see banks have to fund that through the provision expense. So having more income coming through the balance sheet makes a lot of sense. To me, that's the primary reason why you're going to see securities grow.
So this raises a question. Are they taking more risk or just being more aggressive in terms of commercial lending?
I think it is taking more aggressiveness on managing the balance sheet in terms of cash and liquidity. I don't think they're necessarily taking more loans. Loans were positive, but I think generally speaking, we're going to see loans very slow this year across these large banks.
B of A pointed out, Chris, that for sales and trading revenue, this was the highest for Q1 in more than a decade. Chris, where is this strength coming from?
Well, fixed income for sure. I think there's a little bit of better equity activity at certain pockets of the marketplace. I think commodities continue to do well, and they're a player there. So I think it's a little bit of everything that's contributing.
Chris, could you talk to me about the kind of bank, the kind of business model that you think is the optimal way of getting exposure to banks in 2024? There has been this theory that net interest income is going to be challenged this year, that story cuts both ways. What kind of business model do you want exposure to?
Well, I think right now having a balanced attack to where you are part consumer, part commercial, you do have the investment bank that can be helpful. I do think that the wealth management business can be a buffer. So I think having all of those, that's where the large national banks really compete very effectively. By the same token, I think the spread business will be surprisingly better than expected this year to some extent because banks are still resetting loans on the upside. So higher for longer actually has a contribution to spreads rising in terms of loan yields getting better. We think the cost of funds is going to level out as the year goes on, although it's still quite high. It still is a challenge.
Chris, how are they dealing for the Basel III endgame and the fresh regulations potentially we're going to be seeing out of Washington?
So most of the banks have been building liquidity for the last 6 to 9 months, and that's the primary reason that I think Basel III has been a sort of holding back earnings. From the capital standpoint, it feels like we're going to see the change in terms of excluding the unrealized losses for the regional banks above $100 billion. That ship has already sailed. I think a lot of the other changes to risk-weighted assets may not be as bad as expected. We still haven't had a final ruling on that. The risk-weighted assets, the growth of the balance sheet, and how that creates capital calculations is really where some of the nuances are. We still think there's going to be a little bit of relief there, but the main tenets are liquidity and this capital calculation for unrealized losses.
Of course, commercial real estate has been front and center given some of the issues some banks are dealing with. Brian Moynihan told Lisa and John recently when they interviewed him, it's a, quote, slow burn for the banking industry. When do you think that is going to shift? Does it all rely just on the Fed?
Well, I think it's going to shift in probably about 6 to 7 quarters. I mean, we're still in the second, third inning of this credit cycle, and while we may not be anywhere near as bad as we saw 15 years ago, thanks to leverage and more equity in deals, we still have higher losses and higher problems to deal with. So I think the slow burn attitude is correct, but I think it's going to take us deeper into 25. If interest rates come down, it's going to simply give banks flexibility to work through loans a little faster, provide better options to clients to work through as some of these loan resets happen. The maturity walls that we all talk about are real, but there's going to take several years to play through. So we have to kind of deal with what's going on the maturity wall in 24 and 25, and that's the real keen interest that we have.
Hey, Chris, thanks for jumping on with us this morning to respond to some of these numbers. Chris Marinac there of Jenny Montgomery Scott. Shanali Basak still with us around the table. Shanali, had a few extra minutes to go through this. What jumps out for you?
A few things. Even though you had Chris really talking here about this idea that net charge-offs are jumping, provisions for loan losses are lower than expected. So what you see is loans souring a little faster than analysts had expected. Interestingly, also, we have been talking so much. I think we've been really paying very close attention to that drift higher in FICO scores over in Bank of America's consumer base. It is stunning. John, consumer vehicle lending, you need a FICO score above 800 at this point. You need an
800,
average,
seriously?
800. For consumer credit cards, that's 777. It was 774 last year, the same quarter. And if you look at the new accounts, there's a little pressure on that line. So the discipline being instilled by these banks as...
Hold on a second, not to cut you off, but is it discipline or is it the luxury of being at the top? They can say, we want the top, we will give you great deals, and everybody else, oh yeah, hey, you regional banks, you guys can pick up the slack and deal with the charge-offs, as well as maybe some of the increasing problems with respect to demand.
A little bit of both. You're looking at these banks really dealing with higher income customers. You heard JP Morgan say the same thing, this idea that the lower income customers are where you're starting to see the stress. And so when you see credit selection here, you see it very clearly as they're extending debt. Now, what does that mean? Can they kind of squeeze more out of their high net worth customers? Maybe. But another point that Chris was making, the institutional businesses, they have not been getting the premium in trading that these big consumer banks have been getting in the last year. And so this idea that the Wall Street rebound can really save these banks is a bit under question when the VIX is also on the rise, isn't it?
800 is absolutely stunning. Can't get over that. Shanali, thank you. Bank of America down in the pre-market by about 1.3%. More from Shinani in the next hour. We'll get numbers from Morgan Stanley, expecting them around 7:30 Eastern Time. So we're about 34 minutes away. Coming up in the second hour of Bloomberg Surveillance, we'll catch up with Mohammed Al-Erin of Queen's College, Cambridge, and David Hunt of PGIM. A big conversation coming up about US exceptionalism. In the equity market on the S&P 500, just about unchanged through most of this morning, following some of the losses in yesterday's session. Equities right now on the S&P negative 0.1% from New York. This is Bloomberg.
You have this US exceptionalism compared with the rest of the world.
The entire time the Fed has technically been restrictive, the US economy has grown above trend.
As long as that growth momentum stays all right, markets will be okay with it. And that, I think, is really US exceptionalism.
There are still big macro risks in the marketplace.
I think it's sort of nice to say we're not really so worried about what's going to happen down the road, but the market is.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Before we get into the gloom of financial markets, can we just sit on the feeling of the sun on your skin yesterday in New York City?
This is as far as you can go for optimism.
A little glimpse of summer.
Okay.
Just there after a long winter.
And then now you're going to talk about just gloom, heavy gloom. Welcome to winter.
I'm about to.
So you're trying to
just want
uplift
to
it.
soften things up just a little
great.
bit. A little bit delicate. We've been waiting for that. Smiles on people's faces in New York with the sun.
And now. And now.
I know. And now, from New York City, biggest two-day loss on the S&P 500, going back to the bank damage of last spring. In the bond market, massive moves. Let's go through the scores. 2-year, 10-year. The 2-year, very close to 5%, 494. The 10-year, 465. We're talking about new highs for 2024. And the move so far in April, I think we have to start there again. We're talking about something like 12 sessions, something like that for the month of April so far. A move of more than 30 basis points. A move of more than 30 basis points so far in April. On a 2-year, a move of more than 40 on a 10-year.
And it's the pace that has a lot of people nervous. And the reason why, John, you mentioned that earlier, the fact that we're seeing note after note from Wall Street saying that these rates are going to bite into equity valuations, which you're seeing. But the curious thing is, people still want to buy and are overweight equities, which raises a question, where's the leadership going to come from? Not coming from small caps. It's not going to come from big tech because that's been taken on the chin. And what's going to be potentially the driver of growth?
I'll tell you where the leadership's coming from. It's coming from the US dollar and the FX market. That's all I can pick out, OK? I think we're facing the prospect of a 6th day of dollar strength. The dollar is having its longest winning streak going back to September of last year. If you push it through G10 right now, you can identify problem after problem. And I think we have to start with the BOJ. 154 on dollar yen. Remember when they were ready to defend 152? Then 153 happened last week, 154, and we're staring down the barrel of 155 this morning.
And we're staring down the barrel of 160 if you talk to JP Morgan or Bank of America, and people are saying that's sort of the new intervention point. This raises a question, are they going to be forced to raise rates in order to defend their currency? They have to take a more material stance. This goes to a broader question of how much is the disruption in the currency market, the disruption in oil market potentially going to call the hands of central banks that are kind of trying to walk on a string right now in terms of where their economies really are.
So let's go from the BOJ to the ECB. So President Lagarde last week says that we're not Federal Reserve dependent. OK, let's run with that. Then we hear from the Bank of Greece governor that maybe we can continue to diverge. And we've heard from guest after guest that maybe you can, to a degree. And what's going to set the tone for that potentially is in the commodity market. What happens with crude? And what happens with crude, I've got absolutely no idea. We started the session yesterday, the trading week, by discussing a potential response from Israel. Are we going to get one? What does it look like? I think we can answer the first question. Are we going to get one? Israel says there will be a response. What's it going to look like? I've got no idea.
This is the question everyone's asking. And we heard from one of our guests, Janet Lowe, is talking about the fact that Israel wants to retaliate without having to spark a revenge cycle. That's very delicate. Do you do something potentially with cyber? Potentially that goes a little bit less of, bombs going off and it's a little bit more delicate? Or do you go for something like a nuclear facility, which I'm struck by the fact that Iran is saying that they want to keep them all closed because of security issues?
Crude just about unchanged today. Let's start with the price action in financial markets, starting with Brent, 89.80, down about 1/3 of 1%. WTI down by 0.4%. 85. Need to talk about some earnings. Equities just about unchanged on the S&P 500. Lisa, B of A out about 15 minutes ago. Bank of America, upside surprise on trading revenue. The stock is basically unchanged in the pre-market.
Upside surprise on trading revenue, and as Sonali was mentioning, net interest income actually coming in above expectations, different than what we saw over at JP Morgan. The statistic of the morning, though, has nothing to do with any of these headlines. It's what Sonali said, which is the FICO score, the average FICO score, I believe, on auto loans is 800. This is basically somebody who paid every bill before they even got the bill. This is somebody who has so much money that they don't even want to borrow, but they do just so that they can have an 800 FICO score. This is banking to the elite, and this is sort of the divide between the big banks and the smaller ones.
I'm pretty sure no one around this table, apart from Mohammed, can get an auto loan from Bank of America. Is that right?
Basically, don't even try. I mean, the Tesla sort of mega truck or whatever he drives around the city is going to be financed with a loan.
Mohammed can speak for himself in just a moment. Coming up this hour, Mohammed Al-Erin on the global stock market sell-off. Bloomberg Sonali Basak breaking down Morgan Stanley results. They drop in 25 minutes' time. And PGIM CEO David Hunn on why he says bonds are back. We begin with our top story. Equities delivering the biggest two-day drop in about a year. Mohammed Al-Erin of Bloomberg Opinion writes in the following: I've been arguing for almost a year now. Here and elsewhere, the US consumer price inflation would become sticky. Wednesday's hotter than expected data release, the third in a row, is evidence that this scenario is indeed unfolding. Mohammed's with us around the table. Mohammed, good morning to you.
Good morning, John.
It's good to see you. I won't ask you if you can get an auto loan from Bank of America. I will talk to you about what you've been writing about, though, extensively, and I think the rest of the street is catching on. I think the rest of the media is catching on as well. The amount of times we've all read articles over the last few days talking about US exceptionalism. This is something you've been touching on. What are the sources of it, Mohammed, and how durable do you think they are?
I think you have two sets of sources that speak to US exceptionalism. One is the inherent attributes of the US. It is more flexible. It is benefiting from higher labor force participation. It is more entrepreneurial. And then there's a second element, which is policy. It's been running a very, very loose fiscal policy. We're running deficits of 7% when unemployment is under 4%. That is unthinkable, but it's happening. But also, importantly, the US is investing in the drivers of tomorrow's growth. And it's way ahead of other countries in that. And I think if you put all that together, you get this incredible engine that drives exceptionalism.
How sustainable do you think the second element is? Policy.
So I think it is more sustainable than people realize, but there is a limit to it. Look, this can be derailed by one of two things: oil at 110 or a Fed that's too tight. Those are these two things, and if they come together, which is a possibility, the geopolitics gets worse, then you could derail U.S. growth.
You wrote about this just in terms of the pressures of what's going on with the Middle East and the potential increase in commodity prices on the heels of that. One kind of theme we've heard is that Europe will be hit much harder than the U.S. You're saying maybe so, but it doesn't mean that the U.S. is immune. Can you elaborate?
So I think the U.S. dominates in relative space. It dominates almost regardless of what the global scenario is. But in absolute space, the U.S. has dominated so far. And for the U.S. to continue to dominate, we need to avoid really high energy prices, and we need to avoid another policy mistake. So it will dominate in relative space for a very long time.
This goes to the question that ECB board members were talking about, which is that they might not be able to cut rates because of geopolitics. Do you think that this sort of 1-2 punch is looking more likely for the Federal Reserve as well, that they will keep rates higher for longer in response to higher commodity prices, even at a time of a potential shock that could curtail growth?
So, Lisa, this is a great question, because I think most people, not everybody, most people on your show have now agreed that the last mile of inflation is going to be complicated, that inflation is more sticky. Where there's massive disagreement is what the Fed should do and what the Fed will do. All right? There's massive disagreement. There are those who think the Fed should hike. You had the UBS today showing 6%. There are those who think, like me, the Fed should maintain its course and cut twice this year by 25 basis points. Now, why are we all over the place? It's because we disagree on what our star is. We disagree on what the right inflation target is. And therefore, we disagree on how the Fed can best meet its dual mandate. So this is where it's going to play out over the next year. In order to predict the Fed, if you think they will remain data dependent, which they are today because they got so embarrassed by what happened in 2021, then the Fed will not cut. If, however, like me, you hope that they will go from excessive data dependency to also having a macro framework in their head and looking forward, then they would cut. And that's what we're going to see play out in the next few months.
But if they are data dependent and you see inflation, we had hot retail sales yesterday, and they do start to get more concerned about inflation, is it not just they're not going to cut, like the UBS note? Do you think they could hike?
Look, if inflation gets much worse, they could hike. But I think if they do hike, we're going to have a regional banking crisis. We're going to have all sorts of damage in the marketplace. And I think that is at the back of their head. So I think the likelihood of them hiking is low. Is it zero? No, they could.
What's the difference between them hiking 25 basis points and just holding for the rest of the year? How big is 25 basis points?
The minute they hike 25 basis points, they open the way to hiking more. That's the difference. We're going to see today, Chair Powell is going to try, I think, to do exactly what he did earlier, which is maintain maximum optionality. On the one hand, I think he's going to basically say the inflation story has not fundamentally changed, and he's going to probably use the word fundamentally. On the other hand, he's going to say, well, we need more evidence to know what we're doing. And he's going to keep his options open, and that's what he's going to keep doing for a while.
Is it too early to move away from bumps in the road? 3 bumps in the road?
I would have moved away a long time ago, but they probably will maintain the bumps in the road.
You talk about all the disagreements, and I'm still sitting here thinking about what Fed Chair Williams, New York Fed Chair Williams said when he said, we're not really thinking about the target. We're just kind of playing it by ear and taking the data. And you talked about how the biggest debate among you and your colleagues really is, where is the end point? It basically is the destination is the biggest issue. What gives you confidence in your goal of the destination that makes you think that they should just sort of adopt some kind of belief and go with it rather than just kind of live in the morass that we're living in of just complete confusion?
So confidence I don't have, hope I have.
Okay.
I mean, there's a difference between confidence and hope. They do have a dual mandate. They do understand how exceptional U.S. economic performance has been. They're proud of it. It's incredible. I mean, you opened up with how depressing it is that we've had 2 days of massive losses. If I had come here in December and said to you all, the market is going to reprice Fed cuts from 7 to under 2, and the S&P would be up 6% in April, what would you have said to me? You would have said, you're nuts. Okay, we're still up 6% on the S&P, right? We were up 10% in the first quarter. So to go back to your question, I don't have confidence, I have hope. That's what I have. I have hope that they'll understand that they need to get away from this excessive data dependence, and they need to look forward, and they need to have a view. They're being pressed hard on tell us what your view is. And at some point, they're going to have to deliver on that. Now, President Williams has said, think about the target. You're going to hear this term longer term come in every time to talk about the inflation target. Yes, it's our longer term inflation target.
Yeah.
Right. Or medium term inflation target. And that's the way they're going to do it. They're not going to come out with some massive statement. They're just going to start obfuscating what exactly is meant by a target.
Can you imagine if Chairman Powell came out this afternoon and said, I don't have confidence, I have hope? Can you imagine how that would go down with financial markets?
You know what? People would clap. They would say, finally, you're telling us the truth.
End of days type stuff, I don't have confidence, I have hope. Mohamed El-Erian's going to be sticking with us. Equities right now just turning positive. Hopefully. Equities right now positive 0.1%. Let's get to the Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Donald Trump's first criminal trial got off to a slow start. Proceedings stalled over disagreements about evidence and other last-minute arguments. It meant the jury selection didn't kick off until the final hours of the day. The former president's lawyers also argued with prosecutors over which evidence would be admissible. More than half of the first panel of 96 potential jurors had to be excused after saying that they couldn't be impartial. Trump will be back in court today. Shares of UnitedHealth higher in the pre-market trade. It reported first quarter earnings that beat, and it affirmed its outlook for the year. Analysts had warned of unpredictable results following a cyber attack in February. United does say that they continue to make significant progress in restoring the affected services. Boeing is recommending that operators of its 787 Dreamliner inspect a nose component that helps maintain pressure in the cabin. Boeing engineers are already carrying out a multi-year study of the wide-body plane's structural integrity. Now that study is in the spotlight. Engineers say that they found no risk of premature failure in the 787 carbon composite body. But the Senate at the same time is set to hold a hearing tomorrow with testimony from yet another whistleblower. That's your Bloomberg Brief, John.
Danny, thank you. I tell you, the sooner we stop hearing about that company, the better for everyone, including that company. Up next on this programme, the uncertain path to rate cuts.
We will need to start a process at some point to bring interest rates back to more normal levels. And my own view is that that process will likely start this year.
New York Fed President John Williams sitting down with Bloomberg's Mike McKee. We'll catch up with Mike in just a moment and get reaction from Mohammed from New York City this morning. Good morning. If you are just joining us, welcome to the programme. Equity futures on the S&P 500 positive here by 0.1%. In the bond market, the sell-off continues on Treasuries. Yields higher by 5 basis points, 464.88. Under surveillance this morning, the uncertain path to rate cuts.
I think monetary policy is working at the rates that we have now. So I think monetary policy is in a good place. We will need to start a process at some point to bring interest rates back to more normal levels. And my own view is that that process will likely start this year. But again, it's going to be driven by the data and achieving our goals.
Here's the latest. Traders pushing back rate cut bets on strong U.S. economic data ahead of comments from Fed Chair Jay Powell and a string of other central bank officials. Joining us now to discuss is Bloomberg's Mike McKee, who sat down with the New York Fed President John Williams just yesterday. Mike, great work yesterday, buddy, as always. What jumped out to you in that conversation?
Well, I think the fact that the Fed is anxious to cut rates and the thing that wasn't said in between those two sound bites there is the reason they think they need to cut rates by sometime this year is that real rates are high, and they're afraid of lagged effects of that hitting the economy. So they're looking to cut rates if they can. But as Williams said, and Mary Daly added later on yesterday, and they're all saying now, we don't have to move yet. We can wait for the data on inflation and make sure it's going down.
Mike, I love the interview. It was really interesting. I found it most compelling when he said that they don't necessarily talk a lot about or think about the long-term target. It's basically a play-by-you-go, feel it out. Let's take a look at the bumps in the road, figure out whether they're big bumps or small bumps. Do you take him at his word, or do you think that they're thinking very seriously about R-star and that neutral rate?
I think they're starting to think about it, but on an individual basis and long run, long run, they don't have to do anything because it's the long run and things change. But it was fascinating that he said he started to think the neutral rate might be higher because, of course, he's Mr. R-star, Mr. Neutral Rate. And if that's the case, then that would probably mean interest rates stay higher for longer. They would be higher, certainly, than they were in the pre-pandemic era when they were down around zero. But the question is, how far back down do they go? And it sounds like the Fed's beginning to think maybe not all that far.
Mike, great interview, and I like the way you got him both to say data dependency, but also to acknowledge that the tools act with a lag, and you've got to look forward. So on the first point, how do you think they will characterize the latest inflation number, and how do you think Chair Powell will characterize it this afternoon?
Well, that's an interesting question because, of course, they thought that it was a one-off in January, and they thought that maybe it was a two-off in February. But a third one, you've got to say it's a bit of a trend. But they do think that we are going to see prices continue to fall, albeit very slowly. And, of course, they rely on the PCE rather than the CPI. So they're a little bit less worried because when you do all those calculations to translate CPI to PCE, they're expecting PCE to come in lower. But they also think now, I think they bought into the idea that inflation is sticky and it's going to take a little while.
Mike McKee, thank you, sir. Great work as always down in Washington, D.C. Bloomberg's Mike McKee there breaking down the latest Fed speak. Final word now from Mohammed, who's with us for the next 5 minutes or so. We talked about U.S. exceptionalism. We touched on this a little bit as well. The prospect of central bank divergence. What do you think the limits of that divergence are? And which central bank are you more focused on at the moment?
So I think we're going to see quite a bit of divergence, not only in policy, but also in outcomes. And it's being driven both by the macro, but also what's happening at the sector level. You know, the growth engines are very unequally distributed around the world right now. So this divergence will increase. And I love the fact you said a 154 yen was sure to trigger intervention. It hasn't. And that's because the authorities are a little bit frozen around the world as how do you react to generalized dollar strengthening? How do you react to generalized increase in interest rates in the US? And unfortunately, in the past, when those two things go too far, they break something elsewhere. And that's what a lot of us are going to be worried about going forward.
Do you think something's breaking right now?
I don't think so. I think the global economy has shown resilience. I'm fascinated to hear what the IMF is going to say at 9 o'clock this morning. Does it extrapolate forward the strength, or does it say, you know what, the strength was good, but you cannot extrapolate forward? I suspect they'll take the latter, but it'll be interesting to see.
Where do you think something would be most likely to break?
It tends to happen where balance sheets are imbalanced, so keep an eye on certain regional banks. It's not a banking system problem, it's a problem of a few banks. And then keep an eye on a few countries whose debt dynamics are unsustainable.
Like
a few countries.
Okay. Okay, well, that was informative. I am wondering, though, as we look forward, this raises this question of, is this sort of a restrictive rate for an economy that does show a lot of heat? Are we seeing breaking points? People have been saying this for so long. Look at the cracks. Look at the cracks. The cracks never get bigger. In fact, they've even gotten smaller so far. At what point can you say, all right, you can have a couple of regional banks that fall out of bed, but we can keep chugging along?
So I don't think the cracks get smaller. I think the cracks get covered by liquidity. Okay, I mean, let's not forget that the US guaranteed every single deposit in reaction to what happened last March. Right? That's how the cracks got covered over. They didn't disappear. They just got covered over by changing policy. So we have used balance sheets to cover over so many cracks. And at some point, we will reach the end of the ability to use our balance sheets.
Whose balance sheet?
We've used the fiscal and the monetary balance sheets over and over again.
Do you think we're testing the limits of the fiscal balance sheet?
I think if we were prudent, we would believe that. But I don't think that the political system is going to allow us to believe that right now.
What do you think that's going to look like in 6, 9 months, 12 months' time?
No different from today. We're going to continue to run very high deficit.
Just keep pushing.
We're going to continue running very high deficit at a time when we should be using economic exceptionalism to fix the roof while the sun is shining, to quote Madame Lagarde.
Without the other? Would we have US exceptionalism, but we didn't have problems on the balance sheet?
Yeah, there's a lot of good in this economy. There's a lot of entrepreneurial, there's mobility, there's labor force participation. There is a lot going on. There's tremendous innovation going on. Yes, we would.
When you say, though, earlier in the conversation, you said American exceptionalism is because of fiscal policy, all the money that's being floated in. So how do you want them to do that and rein in the deficit?
So I said, including policy, fiscal, but also investing in the growth engines of tomorrow. Right. So it has helped. There's no doubt that the very loose fiscal has helped. Totally agree with that. But what I've even more encouraged is how much is going into generative AI, into life sciences, into sustainable energy. That is what's going to power growth tomorrow. And if you look at, to take it to another part of the world, if you look at the official reaction to China's growth, they beat. They significantly beat expectations and their target. But they warned that the underlying growth dynamics aren't strong enough because they understand they've got to pivot to tomorrow's engines of growth, not yesterday's engines.
I just wish we had Bramo Cam up as you were talking, because Bramo would have told you something very different. You know, they beat their own expectations. Bramo seemed very skeptical when you started talking about China's GDP beat.
They are going to look forward to an era where they're going to try to juice their economy by investing in factories to export cheap goods to the rest of the world, which really raises this question about how much really you can diverse international policy from domestic policy. But I don't want to digress too far.
And they're back to using a weaker currency to promote that.
Exactly.
Interesting move overnight, yeah. Agreed. Mohammed, this was great. Hopeful, not confident. Okay, going to run with that for the rest of this week. Hopeful, not confident. Mohammed Al-Aaron of Queen's College, Cambridge. Mohammed, thank you.
Thank you for having me.
Thank you, sir. Coming up very shortly, we'll catch up with PGIM's CEO, David Hunt. A big conversation coming up about the bond market, fixed income, treasuries, credit. Bramo, so much to talk about. The prospect of a new era, a new regime.
Weakflation. That was his word. And what exactly that means at a time when everyone's talking about American exceptionalism and growth and strength. Where does the weakness, those cracks that have been papered over with liquidity? Love that idea.
He thinks bonds are back. I can tell you the sell-off is back. Treasuries are down, yields are higher by 5 basis points. The 10-year 4.65. On a 2-year currently higher by 2 basis points at 4.94. Equity markets pulling back just a little bit. We're down by 0.1% on the S&P 500. We wrap up earnings season on Wall Street up next. We're looking for numbers from Morgan Stanley. Sonali Bassett's going to break that down for you in just a moment. Those numbers something like 4 minutes away. Welcome to the programme and good morning to you all. Equity futures on the S&P 500 bouncing back just a little bit. Let's start with equities. Up about 0.1% on the S&P. Biggest two-day loss on the S&P 500 since March of last year. Doing a little bit better this morning with the emphasis on a little bit. The Russell is still down by 0.6%. If you switch up the board and get to the bond market, some just massive levels we've broken through over the last month or so. I just mean the speed of the move more than anything. We haven't taken out the highs of last year, but we've certainly set new highs for this year. Very close to 5% on a 2-year, a move of more than 30 basis points so far in April, a move of more than 40 so far in April on a 10-year maturity, up 5 basis points to 4.6488. We'll talk about the bank earnings in just a moment. Morgan Stanley just dropping. Lisa's going to look at that. I'm going to look at foreign exchange for you. Dollar strength, potentially a 6th consecutive day of it. The longest stretch going back to September of last year. The euro trying to bounce back to 106.31. Dollar yen, I tell you what, we've got a problem, BOJ. 152 was problematic. 153 really is. 154, I think they're in no man's land now. 154.67 pushing 155. That currency pair positive by 0.25%. The numbers from Morgan Stanley drop. Lisa, let's get sort of a 35,000-foot view and then we can cross over to Sonali. What jumps out to you?
The fact that they did beat on fixed sales and trading. They also had compensation expenses come in higher than expected. But to me, net interest income is what stands out. We just saw Bank of America beat on net interest income. They actually missed $1.8 billion versus the estimate of almost $2 billion, raising a question of how some of these banks are using their balance sheet to really get ahead of some of the and offset some of the areas that are under more pressure.
First quarter wealth management coming through. Net revenue $6.88 billion US dollars. The estimate 6.69. If we can bring up the stock in the pre-market, the stock is positive by a little more than 3% at the moment at my last look. Let's cross over to Sonali Bassett to get more on these numbers. Sonali, what do you see?
There are a few things going on. One, to the point you're making, you have that wealth management number coming in above estimates and the pre-tax margin also coming in above estimates. Remember, they're going to want to see that wealth engine keep driving performance. You also have them come in better than expected over in fixed income and equities trading, I believe. But what's interesting here, John, is that equities trading number actually comes in below what Goldman Sachs had brought in. So the competition is pretty stiff here on Wall Street today. Another thing to look at as well is the compensation expense coming in higher than expected. We've been talking about it. This has been a trend, a lot of pressure on compensation costs in the year where activity is jumping back. Over at the investment bank as well, you have underwriting fees for equity and debt coming in above estimates, but advisory is coming in a bit light. You have to understand this is another area of stiff competition. Goldman's advisory fees, for example, are more than double what you see over at Morgan Stanley. So those core institutional businesses will be where Ted Pick will have to show where the market share is being gained and lost amid those businesses.
Sonali, you mentioned Ted Pick. This is, I believe, one of the first earnings seasons we actually hear from him, or second or third, but he just took over from Gorman. There's a question of what does the new Morgan Stanley look like? Do you have a sense from these numbers about where the shift is in terms of focus?
Listen, it's interesting you say that. This is actually the first full quarter that you have Ted Pick reporting results. And so right out of the gate, this is his first scorecard. And to the point that you're making, the new Morgan Stanley, remember, it's been driven very heavily by that asset and wealth manager. They have been the kingmaker in U.S. asset and wealth. And while we see that revenue holding up, that competition in the investment bank is something that he's been focused on. He said investment banking will lead the cycle with compensation costs on the rise. How are they going to pay for those bankers? And how are they also going to regain that share in that equities business? We were talking about it yesterday. When we talk to folks on the street, they see him showing up. They see him being competitive. We know that Morgan Stanley wants to retain its top spot here on a lot of those institutional businesses. What's interesting, though, is the market has not been rewarding those core Wall Street businesses yet. They don't seem to be convinced that volatility won't stifle stifle the windfalls. And so hearing what they have to say after Goldman Sachs on how far they can run in institutional will be a question.
Some names are doing better than others this year, Shonali. I think we all know that last week was a tough week for the banking sector. The banking sector was down about 5% on the S&P 500. Shonali, year to date, though, just going through some of the stock moves, let's look at the scores. Goldman's positive by 4%. Citi's up by double digits. JP Morgan's doing OK. Shonali, I'm looking at Morgan Stanley. Morgan Stanley's down on the year. What is holding back that stock?
It's pretty stunning. It's not even down by a little bit. And of the big six banks, to your point, it's the only one that's down, let alone down by that margin. And for Morgan Stanley, they do bank the wealthiest of the wealthy in the United States. This shouldn't be as messy of a story. But you do have a massive management change. And then you have this other question about investigations being faced at that behemoth wealth and asset manager. So it's both the succession story that creates a lot of questions, as well as those investigations that you don't see in this earnings report. This is a question of how Ted Pick will be able to address this on the call. Is there any reputational damage, and are there any potential financial levies that could be seen over at that wealth manager at the end of the day? Remember, this is also a matter of, are people moving money out of cash and into markets? There's a sense that that's coming. The revenue being higher than expected at the wealth manager is a positive signal for that. But let's see how quickly that actually translates.
We can have that conversation right now. Shonali, wonderful to catch up with you. Shonali Basak there, breaking down Morgan Stanley, the last big name out of the gate on Wall Street, wrapping up banking earnings. I'm really pleased to say that joining us now around the table is David Hunt, the CEO of PGIM. David, good morning to you, sir.
Good morning. It's nice to be with you.
Thank you very much for being with us. I want to pick up on Shonali's comments at the end there. The prospect of money coming out of money market funds and migrating elsewhere. Are you beginning to see that trend develop?
You know, Jonathan, we are seeing that. We've seen that really for the last 6 months, but it's been in small pieces. But I do think it's beginning to pick up steam. And some of the reasons are obvious. You know, certainly at a higher level of interest rates relative to money market funds. And as we begin to see rates peak and then decline, duration begins to look a little bit more attractive. But there are two other things that are going on which are at least as important. One is that the big pension funds with higher rates are actually better funded. And so they actually are using this as a chance to de-risk, and that means for them, they are moving money into fixed income. And the second is that, you know, we have the continued demographic trends going on, not just in this country, but around the world. And retirees need income. So we are in the process now of this huge shift from accumulation products to decumulation and income products. And those need fixed income. So if you take the kind of short-term shift, you add to them two structural shifts, we think over the next 3 years, we really are going to see bonds are back.
This sounds like a new regime, and I'm going to give your team a bit of a shout-out because you're a modest man. Mike Collins, Greg Peters, Robert Tipp, just absolutely phenomenal. Pre-pandemic, really defining that bond market regime of yesteryear. Can you talk to me about how different this regime is going to be compared to that one?
We think it will be different. And you're right. They were right on the lower for longer for quite a long time in that. And then more recently, our call has actually been that we're going to be higher. So if you go back 6 months, we were very early to the, hey, we're looking at kind of 2 cuts for 24 when the market was pricing in 7. And we held with that view, and the market's kind of come back to us at this point. So we pride ourselves on taking, I think, considered non-consensus views that are long-term in nature rather than simply trading views. And I think that we've made a very good job on those. And I will say that in order to do that, you need a culture that supports people to take those non-consensus views, even during times when they don't look so right. And many organizations have a hard time doing that, and we're proud of our culture to do it.
To rip up the script just quickly, because I have got Tom Keene's shadow over me, and all of these banking earnings have come out with compensation expenses coming up. Is it getting harder to recruit and keep that kind of talent?
No question it is. I mean, if you look just over the last 20 years, you would say that many of the functions and things that used to be done in the investment banks are now being done on the buy side. I mean, I have more than 130 credit analysts. You would never have seen that, before. All of that would have been done, by Goldman Sachs and Morgan Stanley, and we would have bought research from them. So the actual value chain continues to move from the sell side to the buy side, and that's a trend that I don't think is going to change. And that, of course, puts a lot of pressure on those of us on the buy side, because we do need to move our compensation levels up in step with that. So the war for talent is very real and very practical for us day to day.
So artificial intelligence, how do you use that? And I really am diverging here. I was going to talk about bonds being back, but this is fascinating to me.
I wanted to talk about Greg Peters' bonus.
Okay, well, you can go there next and talk about the wine bar. But I am curious about, this idea of how you make things more efficient to reduce costs while continuing to prioritize this talent. I mean, how do you see that playing out? Or do you think that some of the gains with productivity are overstated and that it really just comes down to talent and people who can do the job best?
So I think that we are in the midst of a game changer on technology. In asset management over the last decade, technology's mostly been about, can we automate things? Can we get more efficient at things? And so it has been a bit of a cost play. That's not where the game is today. Technology now is allowing us to move data to the cloud and then to do things with artificial intelligence that we never could do before. And so it now is actually being used by our investors. It's actually being used by the front line to make decisions. That's a very different use of technology than it was before, and I think that's very exciting. But it means that we are needing to significantly up our game on the use of technology and making sure that we're employing some of these latest uses of it in our actual investment process, as well as trying to get more efficient in some of the back office functions. But that's different for the industry.
So you're saying it's making you more efficient, but not that it means you need a leaner team.
It means that the quality of jobs that we have will actually be better, because we will take a bunch of things that are kind of fairly rote, and we'll be able to do that much more efficiently with technology. And then we will be able to augment our portfolio managers with technology so that they're actually making better investment decisions. And that's what they want to focus on anyway. So the more I can focus them on the higher value topics, the better and happier they are through the use of technology.
When you look at AI and inflation, well, let's come back to the U.S. economy.
We're going to come back to inflation.
Sorry, that's my fault.
You say there's an outlook for the economy as weakflation. But is that the rest of the economy, or also as well in the United States, where we see continuously hot data?
Yeah, so the big story that I think doesn't really get reported enough is that the world has never been, at least in the last couple of years, more divergent in their views of growth. So spending time in Europe, I would say actually the UK is in a technical recession right now. You spend time in Germany, boy, growth is really hard to come by and is not looking so terrific. And inflation continues to be a worry, but it's come down a lot and is related mostly to energy prices. You move to the U.S., and actually growth is higher than most people thought. The labor market is in excellent shape, and growth appears and productivity appears to be better. Inflation is higher and rates are higher. I just spent last week in Japan. And, it's fascinating. After literally 30 years of trying to get inflation to go again, it's a beautiful spring week. The cherry blossoms were out, and there is a spring in the Japanese step. They finally have inflation coming back. They have productivity numbers that look better. They have some growth. And so the stock market is at an all-time high. And you feel an optimism in Japan. We saw the numbers come out of China. So China continues to push on manufacturing in order to get their economy going. I think all of us wish that they had the tools to get domestic personal consumption going, because that's really the rebalancing that they need in their economy. The way they're going right now is just going to flood the world with cheaper manufacturing goods, which is, maybe going to export deflation back to kind of 5 years ago. But it's not the balancing that we would hope. And I think that if they could get their domestic consumption going, it would be good for the Chinese people, good for the Chinese economy, and better for the world economy. So the reason we come to weakflation, to come to your question, is that the world is very different. But when you put all of that together, growth is going to slow from what it has been. And we are going to have higher inflation, we believe, for longer. and higher rates. And that's where you get the weakflation piece of it. And it's very different from stagflation, where obviously the labor market is in bad shape. We think the labor market is pretty strong.
There's a ton to unpack there. Yes. I want to unpack the China piece of it just a little bit and focus on that. That growth model at the moment is controversial. It's getting all of the wrong kind of attention from policymakers worldwide, particularly here in the United States. And there is talk of maybe even more policies going against China from the United States. Secretary Yellen's been talking about that over the last week. Does that make it harder for you to run a global business? Is it more difficult now than it used to be?
Yes, it certainly is. And I think many of us are headed down to the IMF meetings this week. And I think that one of the big topics is going to be, what are the impacts of the new Chinese economy, and what will the U.S. administration do in response to that? I will say, having spent a week in Japan, that the country that is the number one beneficiary of the tension between the U.S. and China is Japan. When I was there, there were 3 companies launching new chip manufacturing centers there. There was companies that wanted to invest more in Japan. And so Japan has actually taken on a role in Europe, in Asia, and in a pan-Asia trade war that they didn't have before. And the other thing that's happened is that the security alliances have come together, I think, faster than any of us would have thought. When I spend time with folks in both the diplomatic and security world there, the coming together of Japan, of South Korea, now of the Philippines and Australia is creating a stronger alliance than we had before. And so, you know, these kinds of reverse powerful impacts that we have are hard to predict, but they do change those supply chains quite a lot.
You've mentioned Japan a few times. You visited there. You're building out the business there. What are you up to in Japan?
So we are one of the largest foreign asset managers in Japan. We absolutely believe that it's a critical country. Obviously, if you just look at where is the money around the world, Japan remains one of the wealthiest and highest savings places. So there's a lot of money to manage.
Is that money coming home?
So the money is coming home to some extent, but also foreign money, as I mentioned, is going in, both portfolio flows and FDI, which, again, is a fairly new story, Jonathan.
It's a massive change. David, I'm pleased to say you're going to stick with us. Got a lot to talk about. David Hunt there of PGIM. Let's get you an update on stories elsewhere. Just briefly, here is your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Well said. Israeli military officials say they have no choice but to respond to Iran's drone and missile attack over the weekend. The U.S. and European allies are urging Israel to avoid the kind of tit-for-tat that would spark a wider war. The U.S. State Department says the Biden administration has put more than 500 sanctions on Iranian entities to hold Tehran accountable. Another bank, another upgrade to the outlook for gold. This time at Citi, and the bank says that gold is likely to reach $3,000 an ounce. Their timeline for that is the next 6 to 18 months, thanks to increased investor inflows, of course, expectations. The Fed will eventually cut rates. That eventually is getting longer out now. The precious metal has been on a tear this year, driven by haven flows with wars in the Middle East, increased central bank buying, and consumer demand in China. Shares of BNY Mellon higher in the pre-market. The bank reported first quarter results that beat across the board. Total revenue, $4.5 billion in the first quarter. Total fees jumped 6%. Both of those are a beat. The bank's CEO says growth initiatives are delivering results. That's your brief. John.
Hey, Danny, thank you. Up next on the program, debating the Fed's path forward.
If you think they will remain data dependent, which they are today because they got so embarrassed by what happened in 2021, then the Fed will not cut. I think the likelihood of them hiking is low. Is it zero? No, they could.
More up next with the PGIM CEO, David Hunt from New York City. This is Bloomberg. Equity futures on the S&P 500 positive here by 0.25%. Yields a little bit higher at 4 basis points on a 10-year 464.26. Under surveillance this morning, debating the Fed's path forward.
In order to predict the Fed, if you think they will remain data dependent, which they are today because they got so embarrassed by what happened in 2021, then the Fed will not cut. If, however, like me, you hope that they will go from excessive data dependency to also having a macro framework in their head and looking forward, then they would cut. And that's what we're going to see play out. I think the likelihood of them hiking is low. Is it zero? No, they could.
Here's the latest. Fed Chair Jay Powell speaking later on today as investors look for more clues on the Fed's path forward. The 10-year yield climbing to the highest level since November after solid retail sales data further bets the Fed is in no rush to cut. David Hunter, PGIM, saying this: bonds are back. We anticipate investors will move a chunk of the enormous pile of funds now sitting in money markets back into high-quality strategies that have some duration as they see rates begin to reduce. David, I'm pleased to say, is still with us around a table for some final thoughts. So let's talk about where the money is set to go. We've heard a million times the phrase survive until 2025. Can you talk to us about the pockets of fixed income that you're not constructive about, that you are perhaps even concerned about?
Well, I think that, we certainly have seen, while yields are high, spreads are compressed. And so there are parts of the market right now where you aren't getting paid for the risk. And we would say some of the lower quality areas of high yield and others would fit that bill at the moment. But broadly, I think that there's probably way too much attention paid to exactly when the Fed begins to move, and not enough to the most important question, which is the fact that we're going to have higher rates for longer. So even when they do begin to come down, they're not going to come down that much. And that's going to mean that you're going to have higher yields for the next several years. So as a long-term investor, as the fourth largest bond manager in the world, that's our focus. And we believe that bonds will be a very important part of a portfolio going forward, as will credit more broadly. And we've talked a lot about the public markets, but we're one of the largest private credit managers in the world. And we continue to believe that will be a really good growth engine, both for institutional investors, increasingly retail and high net worth, and for the money management business. Because banks, despite all of the earnings that you all have covered today, continue to pull back from their core lending functions because of capital constraints.
So when you talk about private credit, a lot of people have been going into this field. It is the idea here that there are companies that are becoming unbanked that don't have 800 FICO scores. They're the equivalent of that in corporate speak, that are becoming unbanked in public markets by, frankly, just the banks, that you're selling or that you're buying their bonds, you're holding them for the long term and hoping to clip a coupon of, say, 7-8%.
So it's a combination of all of the things that you said. First of all, there are many middle market companies which are very good credits, but for whom the banks really can't lend to in the way they did because of the new kind of capital regime that came on after the GFC. And if we get another round of increased capital constraints on the banks, that's going to become even harder for them. So this growth you've seen in direct lending, which is lending really into those smaller companies, has been quite significant, and we think that will continue to grow. But the other area in this has been asset-based finance. So for many, many years, most of this was funded, again, by banks and also by the commercial finance companies, whether or not that was aircraft leases or rail cars or solar panels. And that kind of asset-backed finance now is coming more and more into core institutional asset manager portfolios. We've been a fairly large player in that, and we would say as we look forward, we think that asset-backed will be one of the larger areas that fixed income will continue to grow. So you've got, public markets where we see attractive credit. We've got direct lending and some of the higher quality private markets. And you now have an ABF market that is growing. So we remain very constructive on credit, public and private, looking forward over the next several years.
Let's just sit on private and wrap it up there as well. So we caught up with Mark Rowan over at Apollo, who I'm sure you know well. And we said to Mark, can you define the private market opportunity? And Mark said basically everything on a bank balance sheet. Do you think there's enough space for everybody? How big is this opportunity? Because we hear every single asset manager talk about the same thing.
So I think that the good news is that actually private credit, particularly direct lending, is actually maturing. And institutional investors who, for a number of years, all kinds of people got into this business and set themselves up and immediately kind of were able to raise money. I think that period is now over. Institutional investors are much pickier about the managers that they're using to do really private credit. And so we're seeing a fewer managers raise more money in that space, and I think that will continue because investors want to see that you have, multiple track records, that you've done this over a period of cycles, and that you have the credit skills to do it. Your ability to just set up a new shop and raise money, I think, is a lot less now than it was 3 years ago. There'll be a bit of a shakeout in that, and that's no bad thing.
David, I've loved this. We've got to do it again soon.
Thank you for having me.
Thank you so much. David Hunt there, the CEO of PGIM. That final point there, Bramo, that's a pie that a lot of people want a slice of.
But what you can see is the bigger asset managers are basically taking over a lot of businesses traditionally on bank balance sheets. And you see that again and again. And I'm just thinking about, okay, well, who's winning this game? Who is basically losing this game? And how are the banks fighting back? But it just really creates a different type of asset management regime that has many other opportunities that previously were not there.
A massive change over the last few years, huge compared to the previous bond market regime. Coming up in the third hour of Bloomberg Surveillance, we'll catch up with BlackRock's Wei Li, we'll speak to Bloomberg's Nick Wadhams, and we'll catch up with Apollo's Torsten Slok. Torsten Slok over the last couple of months saying no cuts at all for 2024 from the Federal Reserve. We'll catch up with Torsten in just a moment. Equities doing okay, positive here by 0.33%, attempting to bounce from yesterday's losses and Friday's losses too. Yields up by 4 basis points, 4.64 on a US 10-year. From New York City, this is Bloomberg.
I look at 10-year yield, the market is trying to gauge where this is going to shake out.
For bonds, it's still very much an inflation story.
The level of yields in the US looks pretty attractive.
Given positioning on where we have been in yields, I think we can go higher.
Now that we've seen this back up higher in yields, we are having the conversations of let's get ready to buy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Do you remember when rate cuts were going to start in March, and then it was June, and then it was July, and now you're here December, or maybe never? 2024, no rate cuts at all. Torsten Slok of Apollo is going to join us later on this hour, and he's going to build that out a little bit more. And I imagine he feels even more comfortable with that call following a hot retail sales print yesterday. How comfortable is the Federal Reserve? The big three speak today. Fed Vice Chair Jefferson. We'll hear from the New York Fed President John Williams again, and Chairman Powell himself later on this afternoon.
Is he going to talk about hope? Is he going to talk about confidence? Is he going to say anything at all at a time when basically Fed officials have not pushed back against the possibility of a rate cut, at least one, if not two, later this year? They talk about patience. What that means, translated by the market, is you will do what we think, and right now we think fewer than 2 rate cuts is baked in the cards.
Phrase of the morning, without a doubt, goes to Mohammed Al-Arian earlier on this morning. In the last hour, he said, what did he say? I'm not confident, I'm hopeful.
Yeah.
And I turned around and said, can you imagine if the Fed chair came out this afternoon and said, I'm not confident, I'm hopeful?
Yeah, I think that'll be a pretty scary situation for the markets. Mohammed also talked about the fact that although he does think we will see cuts and that you have more people talking about no cuts, the UBS note talking about the fact that potentially they are pricing in a possibility of a hike. It's not their base case, but now you have more people. This isn't just a contrarian idea from one person that used to be a former Treasury Secretary. You actually have people starting to price in potentially, if we have sticky inflation, combination of U.S. growth continues and a labor market that's healthy, could the Fed potentially move to the other side?
You know, if Fed Chair Powell came out and said, I'm hopeful, I'm not confident, but I'm hopeful, I would say thank you. None of us know. Every single person who's come on the show has basically said, we have no clue. I mean, this is a new paradigm. We make the best call that we can and we adjust accordingly along the way. If he came out and said that, I think a lot of people would say, finally, a little bit of a breath of fresh air.
Yeah, let's really get into why you'd say thank you. Equities would be down, yields would be up,
No.
back through 5%
You think so?
on a 2-year.
You think so?
If he started talking about being hopeful and not confident, that would imply everything's changed. Because a month or so ago, this equity market believed that this Fed chair had shifted into a new policy stance, that if you get weakness, he can respond to it. If you get strength, he doesn't need to. That was the Fed put. It's returned. It's supported equities, even with this repricing of the Federal Reserve through the year so far. You start to hear the Federal Reserve back away from that. I think that floor that's been put under the equity market over the last few months starts to be taken away.
A lot of people think that the policy error so far was that Fed put that basically is baked into the market back in December. A lot of people said that eased financial conditions enough to keep inflation hotter for a bit longer. This is one of the things that Torsten Slok has to say. At what point is that tightening in financial conditions what's required to get inflation back down? Do we even want to get it back down, which was something that Mohamed El-Erian was talking about? Maybe let it run hotter for longer because this is the reality of it. There are a lot of big questions here. The Fed doesn't want to weigh in on any of them, and that's very clear from some of their speak recently.
That's what you heard from John Williams yesterday in that interview with Michael McKee. And the last 2 days, then, the solution and not the problem, according to Bramo. Do we need tighter financial conditions? Most people might agree with that. Equities right now on the S&P 500 positive by 0.2%, trying to bounce back, but the repricing in the bond market has been phenomenal. A 40 basis point plus move on a 10-year month to date, and it's April 16th. So we're talking about, 12 sessions, something like that, Bramo, 463.65.
Which is a reason why the speed that you talk about is a reason why you're seeing people finally say, OK, now it might bite into equity valuations. Now this sort of threatens the story because it's coming from a whole different number of aspects, not just the gradual strength, the grinding of American exceptionalism. This is a reason why people are uncertain right now. And the reason why people who thought that stocks were a great buy at higher valuations are getting queasy, even as they come to lower valuations.
493.80 on a US 2-year. Coming up this hour, BlackRock's Wei Li on why she's still overweight equities. We'll catch up with Bloomberg's Nick Wadhams as Israel vows to retaliate, and Apollo's Torsten Slok on his call for no rate cuts this year. We begin with our top story. Investors wrestling with the threat of higher for longer rates and potential escalation between Israel and Iran. BlackRock's Wei Li saying this: the tensions in the Middle East look contained for now, but we see risk of further escalation. We could face elevated oil and commodity prices for longer, reinforcing the new regime of higher inflation and a long-held view that we are in a higher for longer interest rate environment. Wei Li is with us around the table. Wei, good morning to you.
Good morning.
Are you hopeful, not confident, when you're overweight equities? Is that what we are now?
I am hopeful, and I'm still confident, but maybe less so compared to before. And the key question here is around inflation. So we set out at the beginning of the year that this is a year of two parts. The first part will be supported by the narrative of immaculate disinflation, and the second part will be characterized by the reality of inflation roller coaster and higher for longer. And the last 1 week feels a lot like part two. And a question that we're asking ourselves is if this is a blip or if this is part two, which is why I am confident, but less so compared to before. I think this is still a Fed that wants to cut.
Let's do some scenario analysis then.
Yeah.
Let's say we have pulled forward the second half call. What would that mean for stocks?
I think that will be negative. If you think about what stocks are priced for at this current juncture, so far U.S. equities are up more than 6% on the year, and rate cuts at the beginning of the year we had 7 priced in markets, and now there are less than 2. So the only offsetting factor supporting strong equity momentum was earnings, but right now the bar for earnings to surprise to the upside has risen as well. So the equity momentum is having to clear an ever-rising bar, which is why it feels a bit different compared to before.
Where are you more concerned about the earnings picture than you are rates?
Well, I'm positive around earnings picture. Like if you look at kind of the growth dynamics that we have experienced so far, we have had positive surprise to growth. We have had positive surprise to inflation and the boost to nominal growth, which then translates into earnings have been supportive of equity momentum, right? So I'm actually positive on earnings. I'm just recognizing that now that markets are expecting S&P 500 to deliver 11% earnings growth for 2024 versus a historical average of 7%. The bar is higher. I'm a bit nervous, but I still think that there's more room for AI as a theme to deliver. And I also think that there is room for earnings momentum to broaden out as well, given the cyclical manufacturing kind of uptick that we're seeing coming through in the data. So we like industrials, we like energy, we like materials for that reason. These are the sectors that are seeing a bit of earnings outward revisions as well. So we like all of those kind of cyclical aspects, but on top of the AI theme that is still coming through quite strong.
You've talked about being underweight bonds and not necessarily liking bonds, and that's been something that's played out throughout the year for sure. There's a question of what the haven is, and we've been discussing this extensively. Is it still the dollar? Is it gold now, increasingly?
Oh, it's really hard. And specifically when we think about safe haven, we need to understand what safe haven we're trying to hedge, what kind of scenario we're trying to hedge against, right? So if we talk about geopolitics, it's really hard to pre-position for geopolitical events. You know, things happen very quickly, and typically, historically, it has paid to fade those moves rather than to chase it. But I think it still makes sense to ask the question, is this an event risk, in which case, like fading it historically worked? Or are we in a new kind of geopolitical paradigm where actually risk premium is just higher, in which case we need to kind of think about safe haven, maybe structurally long exposures that gives you a little bit of a medium-term risk hedging at a reasonable cost. You talked about gold, but energy as well, inflation-linked bonds, energy equities, and the dollar. Dollar has really worked so far in terms of being a hedge, and what hasn't worked as well in this inflationary environment is duration as a hedge this time around.
Mohamed El-Erian wrote about this, how global markets are well placed to hedge geopolitical risk premiums, but less so if this actually became a serious, wider conflict. How do you see the difference between the two?
Well, that's exactly the difference between if this is an event risk or if this is a new geopolitical paradigm. So if this is an event risk, actually historically not hedging and maybe even fading some of the immediate nervous movement has actually paid off. You talk about people buying the dip when broadly, historically, geopolitical events haven't had longer lasting, sustained effect on risk sentiment. But now if we're talking about risks of escalation and also kind of channels of transmission mechanism being broader, then we have to think about geopolitical risk premium being baked in portfolios needing to be higher. This is where we're talking about being structurally long some of those exposures that I talked about. Inflation-linked bonds in particular looks interesting.
One of the areas you talked about were energy equities and energy just in general. At what point does some sort of rise in the price of oil and other commodities challenge some of the industrial overweights that you have right now, just based on how much it's going to cost in the inflation there?
Yes, energy prices actually $10 increase shaves off global GDP. I think we're looking at 20-30 basis point or so. So we're talking about like meaningful kind of negative impact on growth and inflationary impact as well. So that then feed through to the Fed calculus, right? Yes, of course, this is not core inflation, but if that then anchors inflation expectation, that leads the Fed to be more kind of prudent in terms of rate cut going forward, then some of the cyclical momentum manufacturing upswing that has come through in the data may well stall. So I think there's a kind of I think of energy both as a hedge to our core, but also as a risk.
Well, I just want to finish on foreign exchange. My favorite function on the Bloomberg terminal, very simple one, WCRS, snapshot of G10.
I thought it's WEI.
Year to date. I was going to finish on this. The dollar has absolutely ripped year to date. Stronger against the Japanese yen by close to 9%, the Swissy by close to 8%, the Aussie by something like 5-6 percentage points. It's picked up again over the last week or so. What kind of damage is that doing to the global equity market core? How does that play into the overweight we've seen in Japan? The overweight that's started to come through in places like Europe. What does this chart mean for those trades?
No, it's negative, isn't it? Dollar is inversely correlated with risk sentiment. In the near term, dollar is driven by a rate differential. It's driven by risk sentiment. And currently, it's reaping because both factors are actually supportive for dollar to go higher. So, you talk about our Japan core. We are overweight Japan core, but obviously the weaker Japanese yen then translating to stronger equity momentum. There is a bit of an auto hedge there, but the stronger the dollar goes, the more we should question the overall pro-risk stance that we have.
Wei Li, this was wonderful. It took me a while to get that joke, WEI.
Yeah, that's your favorite function, right?
Took me a while to get that.
You should be everyone's favorite.
You're my favorite. Thank you. Let's get you an update on stories elsewhere. Thank you. Let's get to the Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Morgan Stanley shares are up in the pre-market. The bank's wealth management arm beat on revenue, net new assets, and trading revenue. Morgan Stanley also said that there was a rise in compensation costs, despite headcount falling 3% from a year ago. Tesla down in the pre-market. Two of the company's top executives are leaving. At the same time, Tesla cutting 10% of its workforce to slash costs with EV demand slowing. Sources tell us the cuts could reach closer to 20% in some divisions. Tesla shares down more than 30% this year. Donald Trump's first criminal trial got off to a slow start. Proceedings stalled over disagreements about evidence and other last-minute arguments. Jury selection didn't kick off until the final hours of the day. The former president's lawyers argued with prosecutors over which evidence will be admissible. More than half of the first panel of 96 potential jurors had to be excused after saying they couldn't be impartial. Trump back in court today. That's your brief, John.
Danny, thank you. Up next on the programme, Israel weighing up its options.
Israel proved it has superior military capability, and just as critically, they don't stand alone, that the United States stands with them. There's no question that Iran recognizes the coalition that was put together to help Israel defend itself.
That conversation coming up in just a moment. We'll catch up with Bloomberg's Nick Wadhams down in Washington, D.C. From New York City this morning, good morning. If you are just tuning in, welcome to the programme. Looking to bounce back from yesterday's losses. It's a small one. It's a small bounce. We're positive by 0.15% on the S&P. Yields are higher by 4 basis points on the 10-year, 464.26. Under surveillance this morning, Israel weighing its options.
Israel proved it has superior military capability, and just as critically, they don't stand alone, that the United States stands with them. There's no question that Iran recognizes the coalition that was put together to help Israel defend itself. Again, I can't speak for what either side will do going forward. Iran is increasingly isolated on the world stage. They are increasingly making it harder for anybody in the international community to be sympathetic to any of their inimical interests there.
Here's the latest this morning. Israeli military officials laying out options for a response to Iran's unprecedented attack. Prime Minister Benjamin Netanyahu now deciding the country's next steps as allies warn against a full-blown escalation. Let's catch up with the brilliant Nick Wadhams of Bloomberg down in Washington, D.C. for more. Nick, let's talk about the options. So yesterday we had two questions. Would we get a response, and what would that response look like? Today we only really have one. We are going to get a response. Nick, what do you think the options are on the table? What do you think that response might look like?
Well, there are a few things happening here. One is that the Biden administration is essentially pressing Israel to, I think, go back into the shadows. So we had seen this proxy war for so long where Iranian proxies were attacking Israel, and then Israel was responding in some ways with strikes that it would not take credit for. So assassinations, for example, or cyber attacks and things like that, where it had in some ways plausible deniability in that shadow war with Iran. The U.S. really does not want escalation here. They want both sides to be able to sort of say it wasn't us, for example, and they're really pressing on that for Israel. So I think what you're going to see is a recognition from the Biden administration that, yes, Israel needs to respond in some way. It still sees Iran as a very severe threat, but it should not do something that feeds that tit-for-tat very public escalatory cycle that compels Iran then to respond in its own right.
Well, Nick, then what options are left on the table to retaliate but not spark a revenge cycle?
Well, it's a great question because it really depends on sort of how the target in this case, Iran, interprets or views that attack. So I think what you're seeing, though, is a lot of focus on the cyber realm right now. So there's a lot that Israel could do to hobble infrastructure, for example, in Iran. It may use this as an opportunity to, again, go after Iran's nuclear program. And there's a lot of pressure on Israel to do that. You know, Iran has proceeded with its nuclear program by leaps and bounds in terms of enriching more uranium. That's an obvious target, and it's one that really cannot be solved with military strikes because Iran has done so much to protect that program. So but at this point, it looks a lot like they would use their massive cyber capability to do something. But again, this is very much a live debate between the Biden administration and Israel.
We have news from Axios that Janet Yellen is going to greenlight new Iran sanctions. Nick, what's left to sanction on the Iranian economy, or should this administration be paying more attention about enforcing the sanctions that are already on the books?
Well, that's very true. There's very little in the Iranian economy at this point that has not been sanctioned over the last many years. And, when Janet Yellen says that, in some ways it shows the limits of U.S. leverage over Iran, because it has basically severed the U.S. from Iran's economy through the imposition of those sanctions for so many years. And the fact is, Iran is not quite as isolated as the U.S. would hope. It has some pretty powerful countries on its side that are willing to work with it economically, namely Russia and China. China buying a lot of Iranian oil, and there are a lot of sanctions on Iran's sales of oil, but that's something that the U.S. has not significantly enforced in recent years, and that's why you've seen oil sales from Iran go up. So that may be a target. I think less focus on new sanctions and much more of a focus on squeezing what we know is Iran's main money supply, which is its oil.
How difficult is this for the Biden administration? When they show up to meetings with, say, Chinese officials, there's going to be a menu, a list of options that they want to pressure China. I think right now on top, it looks like this export capacity, the excess capacity they have when it comes to exports with clean materials. We are potentially in a new realm that the Biden administration will put pressure on the Iranian regime that they want to see from China?
Well, the question really there is whether China is willing to play ball. We are in a very different world now than we were in 2017, 2018, where you had some indication that despite the growing tension between the U.S. and China, there was a diplomatic dance happening behind the scenes where you had China and even in some cases Russia willing to help U.S. sanctions actions on North Korea, for example, and also to some degree on Iran, really willingness to reduce sales of Iranian oil. The world has changed just so much since then over the spiking tensions between the U.S. and China, and then also the Ukraine war. And it just feels very much like we're in a situation now where China and obviously Russia are not going to be willing to partner with the U.S. to really put the squeeze on Iran. Also, it's a delicate dance for the Biden administration because they're worried about oil prices. So that's a whole other factor they're thinking about. This is something they want to squeeze, but for their own sake, they don't want to squeeze too hard.
Nick, let's just finish here. Just how much things have changed for you covering national security? It just feels like everything is a national security risk. Nippon Steel, Chinese EVs. Nick, just how busy have you been? How much isn't a national security risk right now?
Well, it's definitely been a busy little while. I mean, the fascinating thing that your question, I think, gets to is how much there is an overlap between economics and national security now. And the U.S. has really been willing to use economic levers to achieve its national security aims. So you've seen that very much in the case of sanctions, but also with export controls, tariffs, all these measures that were not really in the realm of considered national security tools. And now it just feels like there is so much overlap and these things are so interconnected that, I don't think this is going to let up anytime soon. So hopefully see you guys again very soon and we can keep talking about it.
Nick, thank you, sir. Nick Wadham's there, Bloomberg down in Washington, D.C., weighing in. Makes you wonder, who's in the driving seat in the administration right now? Is it the NEC or the NSA? Who runs things?
Well, I also think it depends on what the issue is and also what year you're in. It's an election year, so a lot of decisions are going to be different. You think about the LNG permit hold. Really, that's a national security issue when you talk to European officials. Yet this administration before the election, I think, leaned into the climate individuals in the administration. You look at Nippon Steel. Is this really a national security interest? Because the Japanese officials will tell you that this means that there is greater strength between the U.S. and Japan in fighting China. It's a labor issue because it's an election year. But I think Lisa made this point a few times. National security is doing a lot of heavy lifting in Washington for them to go ahead and exact policies.
The problem I'm coming up against is I don't have a sense of what we're prioritizing. right? And a lot of these kinds of goals are contradictory. Do we want to prioritize the concept of national security and domestic reliance on things like oil and energy? Or are we more concerned about making sure that gas prices are cheap enough? Are we looking to prioritize disinflation and sort of easing some of the concerns for the lower class? Or are we trying to curtail China, which is going to lead to more inflation? There are counter aims here when it comes to national security and economic goals. And there has not been one cohesive theory that seems to encompass both of them in some sort of understandable way.
Well, let's talk about the price on the screen, 89.74. So you remember when Russia went into Ukraine? And essentially the message that was coming out of the administration was that basically higher energy costs are the price we need to pay to punish Russia. And now what I hear is just the absence of that conversation entirely. It is 2024, it is April, and we are a number of months away from November 2024. And every single conversation we've had this morning, and Lisa, I think you've been brilliant today, because you've just kept hammering away at the same point. America's response to every single situation we're talking about at the moment seems to be informed by what happens with that price and what it means come November. And I think that's short-sighted and highly problematic.
Well, it raises a question with respect to pushing for no response to Iran in the near term because you don't want to disrupt the price of oil. But it really goes to the question of, well, are the U.S.'s hands tied in some capacity? And does everybody else know it if the emphasis really is on keeping oil prices below a certain level?
Do you remember COP in Glasgow?
Yeah.
Do you remember that? OK. Thank goodness, for their own sake, that all the things they wanted to happen didn't happen. Thank goodness we have 13 million barrels a day of crude being produced in America right now, because if you think the policy decisions in front of them now are compromised, imagine how much more compromised they would be if production in America was much lower than that. From New York City, this is Bloomberg. Equity markets shaping up as follows, about 1 hour away from the cash open in New York City. Equity futures just about positive by 0.04%. Unchanged on the Nasdaq, still lower on the Russell. The small caps lower by 0.7%. Big moves so far a month to date, in fact year to date on Treasuries. Just really picking up over the last few weeks though. For the month of April, yields a lot higher. This morning, a little bit higher by 2 or 3 basis points. 494.66, up 5 basis points on a 10-year to 463.85. Mike McKee's got some economic data for you. He's down in Washington, D.C. We can cross over to Mike now. Morning, Mike.
Good morning. Well, we have some negative economic news for a change. Housing starts and building permits down on the month more than forecast. Housing starts on a month-over-month basis down 14.7%. The forecast was for a 2.4% decline. They had grown 10.7% the month before. So now we're at a 1,321,000 pace, annualized pace from 1,521,000. Building permits down 4.3%. The forecast was for a 9/10 drop. They are at 1,458,000. So not clear if this is weather or just a rebound effect, but it is one of the first indicators we've seen in a while that suggests a little bit slower growth in the first quarter. These are March numbers.
Mike, can we talk about some Fed officials as well? Later on today, we'll hear from the Vice Chair. We'll hear again from the New York Fed President John Williams, and Chairman Powell later on this afternoon too. Your reaction from yesterday and your conversation with the New York Fed Chief, and how you think it informs what we might hear from Chairman Powell later?
Well, of course, the New York Fed president is the vice chair of the Open Market Committee that sets policy rates. He's sort of the right-hand man of the chairman. So one would think that Jay Powell will sound a lot like John Williams in stressing the fact that there is no hurry to cut rates, but at some point they anticipate they will. We also hear from the vice chairman today of the Federal Reserve, Philip Jefferson. We'll see if he adds to that. I don't think we'll get much more from John Williams today. He's speaking with the president of the Banque de France, but so probably more about French issues. But I do think there is a consistent message now coming from all of these Fed officials that don't expect rate cuts at the next meeting, or maybe even the meeting after that.
Banque de France's Francois Villeroy de Gaillot. Mike, thank you so much. I am curious, though, also about what we were talking about earlier, about the idea of, have Fed officials gamed out the idea of no rate cuts this year. We're going to be speaking with someone who really said this, shocked the world, and everyone seems to be coming to their side in just a moment. How many Fed officials feel the same?
Well, it's hard to know how many feel the same because mostly the message has been that we don't have to rush, but we do think we will cut rates. I specifically asked Williams about that yesterday, and he said we will just go where the data take us. He didn't rule it out, but he didn't embrace it in the same way that, say, Neil Kashkari of Minneapolis has.
Mike McKee, thank you, sir. Michael McKee, breaking down the data and the Fed speak. I was going to say the French have got lots of issues and make it one of those sort of Euro rivalry playful things, but the Italians have got bigger issues.
Yeah, so
you see this story yesterday? It's my favourite story, just an excuse to mention it. Alfa Romeo's had to rename the SUV that they had coming out. It was called the Milano, right? But it wasn't produced in Milan, so they've had to rename it because the Italians have pushed them to. They're renaming it the Junior or something like that. This is Stellantis. They're going to call it the Junior. Stellantis under pressure by the Italians for using an Italian city for a car name that won't be produced in Italy. I think it was going to be produced in somewhere like Poland or something like that. I just love stories like this.
It definitely,
European rivalries.
Yes, just this idea of don't even try to. It's not good enough to be called Milano.
Exactly.
Call it Junio.
Something like that.
Produce
it here is basically the argument. If you want to use the city's names, produce it here.
You know what they should do?
What should they do?
They should think about that with Spanish oil that they then rebrand as Italian oil because they use the Spanish.
They don't do that.
They take the
argument.
No. They take the Spanish olives and then they grind them up, but they produce it in Italy and then they call it Italian.
Are you sure it's not the Spanish pretending that their olive oil is Italian because they can get higher prices for it because Italian olive oil is deemed higher quality on the market? Consumers, that's the market. You're into the market, right? The market has decided that Italian olive oil deserves a premium over Spanish olive oil.
The market's trying to bounce right now, and what we're seeing in the market is a sense
Javier
of people
Bloss
coming
is
back.
in New York, and I imagine they ran into each other in the pantry. Yeah.
Talking points on olive oil. OK, better conversation for you. Stick with us, please. Apollo's Torsten Slog with this to say. The strong tailwind from easy financial conditions continues to boost inflation and growth, including consumer spending in March. Given the ongoing reacceleration in the economy, the Fed will not cut interest rates in 2024. Apollo's Torsten Slog is with us around the table. Torsten, it's been quite a call, and I imagine you're feeling better about that call over the last week or so.
Well, I think that what is happening is that when the Fed pivoted after having said for 2 years rates are going up, now they're actually saying rates are going down, and they're still saying rates are going down. When that change came at the November 1 FOMC meeting, since then, the S&P is up $10 trillion. In other words, the tailwind to wealth in the household sector, the tailwind to wealth for corporates, and therefore the tailwind to consumption, to capex. It's really not surprising that non-farm payrolls for the last 3 months has been strong. It's not surprising retail has been strong, and therefore it's also not surprising that inflation has been strong. And I think that tailwind will continue for the next several quarters.
You're not lonely. Joining you, I think SocGen and Stephen Gallagher in the last couple of days now saying no cuts in 24. Even Matt Lazzetti at Deutsche Bank saying one cut December. Likewise from Mike Gapin over at Bank of America. What's interesting about the way you frame it is you put a lot of this on looser, easy financial conditions. When you speak to the Fed, they say financial conditions are tight, not loose, even with stocks close to all-time highs and credit spreads really tight. So what are you seeing that they're not?
So that's really important because that discussion splits into two things. Namely, if you look only at rates and the level of the Fed funds rate at 5.5, that is certainly above most estimates of R star, meaning the long-run equilibrium interest rate for the economy, which normally the Fed would say is 2.5. So looking at rates on their own in your old school ISLM models in the economics literature, you would look at that and say, hey, you have that exactly monetary policy is tight. But what has happened is that has been completely neutralized and offset by the rise in the stock market, the rally in IG, in high yield, in loans, the incredible increase we've seen in issuance in IG, also in high yield, and likewise IPO and M&A activity coming back. So you have, on the one hand, yes, it's true that your old school textbook model tells you that rates are higher than where they will be in the long run, namely 5.5 is bigger than 2.5, so that tells you policy is tight, but that's completely being more than offset by a dramatic tailwind. You could call it a sugar high coming from the easing in financial conditions, lifting the wealth component for households that is boosting consumption. Therefore, you see increases, of course, in travel, restaurants, airplanes, everything when you come to hotels, concerts, sporting events. There's a huge tailwind to consumer services, and that's why supercore inflation is accelerating so quickly at the moment.
Essentially, are you saying that it was a policy error for Federal Reserve Chair Powell to talk about in December the potential for cutting rates?
See, I don't think this was the intention. I think the intention was to take the textbook out and say, well, when we run Taylor rules and Phillips curve, we get that it only is rates, as John is saying, that matters. And they did not have the intention of lifting financial conditions and boosting the stock market as much as they did. Remember, the S&P is up 25% since November the 1st, and the market cap of the S&P is about 44 trillion, so that brings you to roughly around 10, 11 trillion additional increase in wealth for the household sector. I don't think this was the intention to generate this wealth increase. It just happens to be what I would describe as sugar high that is now lifting for several quarters, because we can't have the stock market going up 25%, but for several quarters we'll get that tailwind where consumers will say, well, my balance sheet looks a lot better, probably better than it's done, meaning for the household sector, than it's done for a long, long time. And as a result of that, consumption is getting a huge tailwind, as the data yesterday was showing.
This raises a question of what happens if the market starts to completely agree with you and bake in no rate cuts this year. Does that curtail some of the sugar high? We're already starting to see some people on Wall Street wonder, okay, are we going to see yields where they are bite into equity valuations, slow some of the capital markets activity? Do you believe that too?
Absolutely. So I do think that the rate hikes that we have had and the 5.5 higher than 2.5, it is already biting hard on highly levered consumer balance sheets, highly levered corporate balance sheets, and also hard on banks, in particular on regional banks. So the consequence of this is that we still have the negative effects of the transmission mechanism. Monetary policy is still working. It's just only working on those balance sheets that have a lot of debt. And therefore, we are working through that process. And as that sugar high starts to fade, if the stock market doesn't continue to go up, you will eventually get that effect to begin to dominate. And that's probably what we get in 2025, when you ultimately will then get the risk of a harder landing. But for now, the economy is certainly riding the wave of the increase in the stock market and crypto prices and home prices and cash flows in fixed income because of all-in yields being so high, being probably higher than they've been for decades. That's very supportive for the household balance sheet.
So just to make this really confusing, if we start to believe there will be no cuts, there will be cuts?
Well, eventually, the Fed has the goal of getting inflation back to 2%, and inflation is not at 2%. If you look at the 3-month annualized change in supercore inflation is 8%. So the trend, in particular in supercore, is really not the Fed's friend here. So the worry is it might take a lot longer to get down to 2%. So that fight against inflation is not over. And the consequence of that is that we may get the market environment for 2022 to come back. Because in 2022, we had stocks down, rates higher, and obviously this was not good for markets and for your 60-40 portfolio. And that environment is at risk of coming back if we're not done fighting inflation.
Torsten, what about hikes? People are actually starting to talk about this.
I think, and this is, of course, in your world, I think that the likelihood of that is still relatively low because there's just so many complications in doing that and in saying, well, we were wrong and now rates are not going down, now rates are going up again. There's also some challenges with the base effects of inflation, some more technical things about we got to go either in July, otherwise it'll be in December or next year, because we have the base effect is very supportive for inflation for the second half of this year. So it's also going to be quite challenging for the Fed to get all that in place in time to turn things around and say, maybe we need another hike or two. I think they will rather, from a transmission mechanism perspective, keep rates higher for a little bit longer, maybe 1 or 2 quarters, and then achieve their goal of getting the economy and inflation to slow down.
So you don't think if we get 2 soft prints on inflation, we end up with a cut in July?
See, but I don't see where those soft prints should be coming from. Retail yesterday, I mean, supercore inflation and shelter inflation is showing signs of coming down much slower than what anyone expected. And if I look at my Bloomberg screen at ISM prices paid, you also get that that's also beginning to accelerate. So even goods inflation, which went through the roller coaster of being no problem, a big problem, and no problem again. Yeah. And now goods inflation, including with energy and oil, you have that goods inflation is at risk of also providing some lift to inflation.
Really, to be honest, Torsten, was a reaction function question, not a forecast question. So let's just assume we do get that data. Do 2 soft prints lead to a cut, given how much they seem to want to cut still at the Federal Reserve?
So let's turn that around and say if they do absolutely want to cut in June or July, we will need some very, very dramatic slowdown in inflation in the next several months. Absolutely.
OK. Torsten, this was great. Just really, really smart. Torsten Slok of Apollo feeling much, much better about his call for no interest rate cuts in 2024, given the hot retail sales print we had in the last week, together with hot inflation and all of the above going wrong for the Federal Reserve. Let's get you some stories elsewhere. Your Bloomberg Brief is here with Danny Berger. Hey, Danny.
Hey, John. President Biden is hitting the campaign trail in his home
home state of Pennsylvania. Biden's campaign says the trip will highlight the differences between the president's tax and economic agenda versus that of Donald Trump, who oversaw tax cuts for the wealthy and corporations in office. Biden's trip includes events in the Pittsburgh area, where Nippon Steel's takeover deal for U.S. Steel has irritated his union allies. Shares of United Healthcare higher pre-market. The company reported first quarter earnings that beat estimates. It also affirmed its outlook for the year. Analysts had warned of unpredictable results following a February cyber attack that impeded the flow of data and payments across the healthcare industry. United says they continue to make significant progress in restoring the affected services. Boeing, yet again in the headlines, recommending that operators of its 787 Dreamliner inspect a nose component that helps maintain cabin pressure. The recommendation comes as Boeing engineers carried out a multi-year study of the wide-body plane's structural integrity, and now that study is in the spotlight. The plane maker facing mounting scrutiny of its manufacturing quality. Engineers say that they found no risk of premature failing in the 787 carbon composite body. At the same time, the Senate is set to hold a hearing tomorrow with testimony from another whistleblower. That's your brief, John.
Hey, Danny, thank you. Appreciate it. Up next on the program, wrapping up bank earnings.
Right now, having a balanced attack to where you are part consumer, part commercial. You do have the investment bank that can be helpful. I do think that the wealth management business can be a buffer. So I think having all of those, that's where the large national banks really compete very effectively.
That conversation coming up next. Equity futures positive here by 0.25% on the S&P 500. The opening bell about 47 minutes away. Equities right now on the S&P 500 positive by 1/3%. I want to talk about crude, pulling back just a little bit. We're down to 85.16. We're negative 1/3%. AMH, some headlines coming through from Secretary Yellen. We're going to hear from her a little bit later. And a conversation taking place between two very interesting leaders just moments ago.
That's right. We're hearing that the conversation took place between President Vladimir Putin and the leader of Iran, Raisi, and Putin asked for restraint, according to the Kremlin. So restraint, that idea that's coming from the United States and Western allies on Netanyahu, seems to also be coming from Moscow on Tehran. And then when it comes to Secretary Yellen, when she discusses and talks to the remarks with the IMF today with the spring meetings, she's going to talk about responding to challenges in the Middle East. She's going to talk about what the administration has laid out during the past 2.5 years, which is sanctions, and potentially signal more to come. But you have to ask, what is left in the Iranian economy for this treasury to go after?
It's not about new sanctions, it's about enforcing existing ones. On those comments from Vladimir Putin, the Russian leader, Lisa, Iran's already said, as far as they're concerned, this is done. This is about Israel now. It's about Israel's response if they want to take one and what that response looks like.
And whether Iran responds to that and then Israel responds to that,
Precisely.
and this sort of domino effect, and what Vladimir Putin really is trying to indicate here. But you're correct. At this point, it comes down to how will Israel respond? What influence do some of the coalition members have on Israel at a time when they're saying 300 missiles were thrown at us?
Crude is down by 1/3%, 85.11 on WTI. Brent crude 89.75. We're down by 0.4%. Up next on the program, wrapping up earnings on Wall Street.
Right now, having a balanced attack to where you are part consumer, part commercial. You do have the investment bank that can be helpful. I do think that the wealth management business can be a buffer. So I think having all of those, that's where the large national banks really compete very effectively. By the same token, I think the spread business will be surprisingly better than expected this year to some extent because banks are still resetting loans on the upside. So higher for longer actually has a contribution to spreads rising in terms of loan yields getting better.
Here's the latest this morning. Morgan Stanley shares gaining in the pre-market. The bank's trading and wealth management revenue beating expectations. It's the final of the 5 big Wall Street banks to report first quarter results. Shonali Bassett with us around the table to wrap them all up. So Shonali, put it all together. What's the big takeaway over the last few days?
Costs are on the rise everywhere. And I think if you're not looking at compensation costs, what's remarkable is in most of these banks, the headcount has actually reduced. And so costs are going up regardless. And so you have to bring in more money to justify for that. In the case of Morgan Stanley, what's interesting is they bought in $95 billion of net new assets at its wealth management unit. They were expected to bring in closer to $60 billion. And so that wealthier individual is really driving performance at the wealth managers in a really competitive market. And people are really excited for these institutional businesses to come back. You have to remember the wealthy individual is almost considered an institution here when you look at a lot of these banks. In fact, even structurally, some of those wealthy individuals, family offices, are moved over to those institutional trading desks as clients.
You set the tone for this, so let's talk about it. 800. The number 800, FICO scores over at Bank of America. Every time those quarterly earnings come out, you talk about this. And now Torsten Slot was walking off the set, and it's all he wanted to talk about as well. Can you go through those numbers again for us?
That was for the consumer vehicle lending business alone, but even credit cards are up to 777. And credit cards are an area where all of these banks are trying to gain more share. The question that has not yet been really answered, are consumers tapping out on credit? Remember, the fact that we have record amounts of a credit card uptick in America already at record high APRs begs the question of whether consumers can take on any more and how much that will start to drive loan growth at these banks.
You mentioned this earlier. We used to think of JP Morgan as kicking off the earnings season. This would set the tone for the rest of the economy. We'd get a read on the American consumer. Can we really say that in any capacity if we're talking about the consumer with, asterisk 800 auto loan, which I've never heard of, FICO score, and 777 on the credit card?
Right. I think there's a really big question mark about whether these banks actually bank America at large anymore. Keeping their savings is one thing, but how much credit is actually being extended and to what businesses? You guys were talking about housing starts a little earlier. Of course, getting a mortgage is hard to come by for many Americans. Auto loans, the same situation. You're also seeing credit start to deteriorate in those businesses. Now, these banks tell you everything's fine, that the metrics for themselves are fine, but they are still under pressure to return capital to shareholders, so they lean into those businesses that are, say, a little bit safer. It's interesting, Lisa, remember, if you're paying an investment banker in an investment banking business, the ROE is very high because all you're really paying for is the banker. But when you get to these big consumer businesses, that's when things get a lot more bloated and you start have to worry about those pesky little things like charge-offs.
The other theme that we've noticed is this question around the toggle between private asset managers and public, and the idea of banks, and this idea that you do have the likes of Apollo, but also evidently PGIM eating the lunch of some of the bigger banks. How much did you sort of see that reflected in the earnings in terms of where banks are leaning in or where they're leaning out and sort of saying, other companies may be better to take this business?
If I told you today that Blackstone was not only worth more than Goldman, but also worth more than Morgan Stanley, most people don't even remember that's the case. By market value, they are larger. They report in 2 days. And it creates a new question. If you're a bank or if you're an asset manager, if you work on Wall Street, is it better to be in the business of moving money or in the business of holding money and putting it to work? Goldman yesterday said that their private credit business can double over 5 years to $300 billion. Well, that's just about what Blackstone has today. In a couple of weeks, Apollo is expected to bring in more than $500 billion be a $500 billion asset manager in credit alone. That doesn't even include equity and other kind of hybrid products. So they're bringing in massive money. Where do the banks make money from that? By those underwriting fees, by facilitating the deals. But again, these asset managers are certainly competitive, and they're competitive on the fee war as well.
Sonali, when you look at the scorecard, compensation costs were rising this quarter. What does it say about the rest of the year?
They have to be making enough to justify that. There have been significant job cuts over the last couple of years on Wall Street. We're at the beginning of a capital markets rebound, but volatility is starting to rise back in the markets. If you even look at VIX futures into May, they're trading higher than the 1-year average. What does that mean? Can equity underwriting keep going? Can debt underwriting keep going? Can they keep going after an election in the United States? And does M&A at a large scale get stopped at the gate, or do they get let through? We know some people are suing to make those deals work, but some companies might turn away from that.
Sonali, you've been brilliant over the last week. Thanks for your hard work. Appreciate it. Thank you very much. Looking forward to tomorrow. I just want to go through the lineup for you. Lee Ferridge of State Street is going to join us. Sebastian Page of T. Rowe Price, Krishna Mamani of Lafayette College, and Data Peterson of the Conference Board. I want to pick out one name, Sebastian Page. What was it? Aggressively neutral.
Yeah.
Has that changed?
We've heard other people say enthusiastically neutral or eagerly neutral. I mean, basically, this is a real question. How do you sort of decide which sort of side of the fence to sit on when it's just such an ambiguous moment? I am curious, too, about his sock choices, because evidently last time he came with some T. Rowe Price socks that went up to my knees.
I didn't notice that.
Yeah.
How did you see that?
Well, no, he handed us some, and I tried them on just to see if they
he
were
brought in
what
merch.
they were. Yeah.
I didn't get any merch at all.
I think he left it on your
T. Rowe Price merch. Did you take mine?
I took your socks.
Nothing ambiguous about these bond market moves. It's just been clearing in one direction, higher, over the last few weeks. We've got a 10-year sitting at 464. A 2-year at 494. And Lisa, what was contrarian, I think, is now consensus. It's going to be a whole lot later if you're looking for interest rate cuts from this Federal Reserve.
The dramatic repricing in rates and the dramatic repricing in rate cut expectations over the past 3 weeks has been nothing short of amazing. The fact that the markets have digested it as well as they have until now is pretty impressive. Question is just, have we breached that level? And that's increasingly what people are saying at a time where there's already this overhang of geopolitics is creating some nervousness.
It's been 5 months since Powell's pivot in December. He's going to speak again today. And we had, 6 or 7 cuts in, and now everyone is quickly moving to the Torsten Slok part of the world. And now I'm still struck by UBS starting to model out the probability, even though it's small and it's not base case, the fact that we can go higher and see hikes because of where we are right now.
Joining us, the man behind that call, Mr. Jonathan Pringle, Thursday, by the way. I think that's a must-watch conversation. The prospect of doing the unthinkable. I think it was unthinkable at the start of the year and maybe sort of like not the consensus view, but becoming more probable, certainly.
I want to know what kind of conversations he's had with clients who read that and then called him up. You know, was it sort of expletives where people saying, you're right, you're totally right, I'm on board too, I just didn't want to say it out loud? Or people saying, it's not going to happen, not a chance, you're just going to hold rates here for a longer period of time? And then what has to happen to get there? I don't know. It's going to be a great conversation.
Let's finish on how high that bar is. So we've had 3 hot inflation prints to start the year, and a core member of the Federal Reserve just did an interview with Mike McKee, and he said monetary policy is in a good place. I think that tells you that it would take a whole lot more for the Federal Reserve to believe it was in a bad place and that they need to hike interest rates.
Especially because high rates where they are affecting a lot of smaller businesses disproportionately, and that's a problem.
The opening bout 34 minutes away. Equity futures positive by 0.25%. Live from New York City this morning. Good morning. This was Bloomberg Surveillance.